Good morning. Let's get started with our next session. Thanks for being here. I just want to, before I hand it over to the first set of authors, remind everybody that the conference is live streamed. So don't say anything too crazy, I guess. The first paper this morning is titled Robust Fiscal Stabilization by Alan Auerbach and Danny Yegan, and I think Danny's going to start.
All right, thank you. Thank you to the organizers for including us. The Congressional Budget Office projects that America's current law fiscal path is unsustainable, but any fiscal path is sustainable if Congress in the future reacts sufficiently strongly to rising deficits. And our paper asks, how has Congress responded in the past to deficits, and how strongly does Congress need to respond to deficits going forward? To study this question, we take advantage for Congress's behavior to date of 40 years of CBO data. Usually twice per year, once in the winter and once in the summer, CBO publishes an update to their deficit projection. CBO divides its updates into those stemming from new legislation and separates them, as in the screenshot, from other updates due to economic or new program information. We use these data to ask whether Congress legislates deficit reduction when the projected deficit rises. We follow Allen's 2003 Brookings paper in constructing about 80 half-year period observations since 1984 with three key variables. The first, Congress's legislated change this period to the average primary deficit over the coming 5 years, as shown in this screenshot. Second, CBO's projected deficit over those 5 years using CBO's projection from the prior period. And then third, as a control for the state of the economy and countercyclical fiscal policy, the lagged output gap based on CBO's potential GDP series. And all variables are scaled by the potential GDP. This graph reproduces Allen's key result from 2003, which, new to this paper, we show non-parametrically. The graph plots Congress's legislated deficit reduction on the y-axis versus CBO's lagged projected deficit on the x-axis. The graph controls in the background for the output gap, so everything we show you is net of the state of the economy. Suffixes A and B on the year data points you see indicate the first period of the fiscal year or the second period of the fiscal year. And the graph shows that over the first 20 years of the available CBO data, Congress, on average, cut the deficit when the projected deficit was high. So Congress acted in a debt stabilizing manner. And if you look at the upper right, you can see a 1991 data point. That's President George W. Bush, famously breaking the no new taxes pledge at a time of high deficits. And if you look in the bottom left, you'll see a 2001 data point, which represents, in a time of surpluses, the first Bush tax cut. The relationship is quite linear, with a slope of 0.15 and a t-statistic of 5. Just over half of the deficit response comes on the spending side, with the balance coming on the revenue side. And it's really the projected deficit that seems to matter, not the lagged debt to GDP ratio or the projected debt to GDP ratio. Okay, so that was then, 1984 to 2003. How about since then? This graph replicates the prior graph, but for the 2004 to 2024 era. And what you see is a flat line. On average, Congress legislated slight deficit increases, and the magnitude of those increases did not vary with the projected deficit. This graph omits the extremely unusual 2020 data point covering the beginning of the COVID-19 pandemic. When we include that, the slope actually goes more negative. And we don't want to overstate the precision of the zero result. We have 40 data points, but we are able to statistically reject the 0.15 slope from the earlier era. And with thanks to Heidi Williams, you can actually see this vivid change in congressional behavior when you put both eras on the same graph. So given this vivid change in congressional behavior, we wanted to ask, okay, how strong does fiscal feedback need to be? We first study gradual year-to-year fiscal feedback as in the earlier era. And then we also take Congress's recent behavior seriously. What kind of wait-and-see strategy would work where Congress waits to take action until if and when it's actually necessary to take action? To finish laying the groundwork, the empirical groundwork, we account for two risks: transitory shocks to the primary deficit and persistent interest rate shocks. So first, recent experience from the Great Recession and the pandemic suggest that one can think of there being transitory shocks to the primary deficit that yield discrete jumps in the debt to GDP ratio of about a magnitude of 25% of GDP, with no analogous sudden jumps in the opposite direction. We assume a Poisson process with an average of 2 such deficit disasters in a century. We assume only 2 because the Great Depression actually didn't yield that much of an increase in the debt to GDP ratio when scaling by the potential GDP, and World War II is less of a clean data point. The second risk we account for is persistent interest rate shocks, as in Doug Elmendorf's and Neil Mehrotra's work as well. As I suggest in a parallel paper, the debt ratio builds on itself at a familiar R minus G rate that can be termed the excess interest rate, the nominal interest rate R, in excess of the nominal GDP growth rate G divided by 1 plus G. This graph plots the excess interest rate over different rolling time periods since America's founding. The mean is negative with substantially large swings and some clear persistence. With thanks to our discussant Valerie Ramey, we use the annual data since the abandonment of the gold standard in 1971 to find an AR1 coefficient of just under 0.6 with substantial residual variance. Okay, with that, let me hand it over to Alan to integrate these facts into a model.
All right, so we, to answer the question, or try to answer the question that Danny posed, which is how much feedback do we need in the current environment? Obviously, we have none right now, but what would we need? So to address this question, we put together a simple model of the evolution of the debt. The first equation here is just the, except for the error term at the end, is just the standard identity relating debt to its lagged value. Rho here is the R minus G term because we're looking at not the level of debt, but the debt to GDP ratio. S is the primary surplus. ES, that is a shock. These are those asymmetric Poisson shocks that Danny referred to in showing the recent evolution of the debt. And we just assume that these shocks are shocks to the debt. And in particular, we assume that they are not shocks that at least the kind of feedback such as I estimated responds to, in part because when I estimated it, I found that it was projected surpluses or deficits that mattered, not any recent changes in the level of debt, even if that's what you might think should affect legislation. The second is the AR1. The second equation is the AR1 process that Danny mentioned, and the EUs are the shocks to the those residual shocks to the interest rate term. And then we have the two gradual feedback approaches. The one that I estimated, which this is slightly modified from the actual version because it's based on the current deficit, which is what's in brackets on the right-hand side, but it's not that different in our model because we're assuming a constant underlying primary surplus. And then the final equation is equation that one has conceived in the literature. For example, in the work of frequently cited paper by Henning Bohn, estimating how the current budget surplus responds to the most recent value, most recent debt to GDP ratio with a coefficient D. So this table goes through all the parameters that we use, but let me focus on the three at the bottom. The C, a coefficient of 0.3, that's twice the 0.15 we estimated for the 1984 to 2003 period because there are two actions within a year. And so instead of just one of 0.15, it's two of 0.15 or roughly 0.3. The second 0.05 for the feedback based on debt, that's just the estimate from Bohn's research. The T is when we say, well, suppose we think Congress is doing nothing, but actually they have a very carefully considered rule, which is that they're going to wait until things get really bad. Really bad is, we take to be what Jason Furman and Larry Summers suggested when real debt service breaches 2% of GDP. And we let T be and we say that when that happens, Congress adopts a 1.5% budget of GDP budget consolidation, which is historically large, and we thought that's sort of about the most one can hope for. And then T says how often they can do it. And because obviously if they could do it every year, then it's not really a wait and see approach. And so we said, well, once a generation or so, let's imagine that they do that. They can do that. This is the results of 1,000, median results for 1,000 simulations, the blue line. This is the debt to GDP ratio over time. We simulated for 100 years. And it's going up because, I didn't mention, but we have interest rates being affected by the debt, which we based on the CBO projections, sort of relating interest rates to debt. And so just because of these primary deficits driving the debt up, which in turn drives interest rates up, you have a sort of a very negative process, which leads to these uncertainty, leads to these high increasing debt to GDP ratio. It's worse in the red dashed line when you have no feedback, but you add risk. And it's primarily because of these asymmetric debt shocks, because they only go one way. The interest rate risk itself, you might think because of nonlinearity that it could also increase the median, but it doesn't. It's really the asymmetric debt shocks. And then the other three lines show under the three different feedback policies. The green line, the deficit feedback that I estimated, the orange dash line, the feedback based on the debt GDP ratio, and then the purple dash dotted line being these sudden consolidations, which they starts out performing worse. But if you can do it every 30 years and you keep doing it and it's permanent, then things look good. I'm going to skip this is basically showing deficits corresponding to the median deficits corresponding, but they're basically consistent. The funky step function is basically the process of sudden consolidations. Basically, the median primary deficits go down in jumps. The surplus. This is the surplus that's going up because, on average, at least, or the median, Congress every 30 years or so is adopting one of these 1.5% of GDP consolidations, which you might think would lead to even better outcomes than we show there, which they don't, which is just an illustration that if you wait 30 years, a lot of bad things can happen. That just shows the excess interest rate term. I'm going to skip and go to the next thing, which is to say, so suppose we ask a question how strong does feedback have to be in order to have success? And I'm going to focus on the case of risk, because under certainty, it doesn't have to be very strong. And under the case of risk, which is in the red line in the bottom of the table, and we say, what is success? Success is 95% of the time, the terminal debt to GDP ratio after 100 years is under 250%. If we were writing this paper 10 years ago, we might have said 150%, but we're less ambitious than we used to be, given where we are. And the answer is, if you look at deficit-based feedback, you need about half of what I found we actually did in the 80s and 90s. Under debt feedback, the estimates from Bone's work are sufficient. Under sudden feedback, though, that 30 years isn't going to cut it. You need to be ready to do it every 11 years. Okay, I'm going to skip to the last table, given that I'm out of time, and ask, given where we are, what should we be doing relative to what CBO projects we'll be doing over the next 10 years? So this is a 10-year projection with no shocks. So it's just saying, suppose that we were following a decision rule, such as one of the ones we simulated, either based on deficits or based on debt. And over the next 10 years, we started with the CBO baseline. And now we said, instead of following the CBO baseline, suppose we were, which basically doesn't include policy changes, that's the nature of the CBO baseline. Suppose we put in policy changes consistent with either of these decision rules. So the CBO baseline here for the primary surplus and the debt are shown in blue, showing a 2.6% average primary deficit over the next 10 years, and with 122.4% debt to GDP ratio at the end of the period. Well, what this shows in red and green is that if you're following deficit feedback, which is sort of the deficit feedback strength, about half as strong as what I found historically for the 80s and 90s, but what we found is what we need for a 95% success rate. Then instead of having averaging deficits of 2.6% of primary deficits of 2.6% of GDP over the next 10 years, it would be 1.4%. So that's an average consolidation over the period of 1.2% of GDP a year. For the debt-based feedback, we find less of only about 0.5% of GDP. The intuition there is because the debt-based feedback is more adept at responding to these big budget shocks, it doesn't have to be as responsive in the short run. And so if we thought we were following such a policy, which historically we didn't in the 80s and 90s, we wouldn't need as much. But if we reverted to being reactive as we were in the 80s and 90s, but only half as much, even only half as much, it would involve substantial consolidation relative to what our projections, relative to what the CBO projections have. So I've run out of time. These are our conclusions, and we look forward to all of your comments.
Our first discussant is William Gale.
How do I make
Click this or use this.
The timer doesn't work for Brookings authors. All right. Thank you. I'd like to thank John and Jan for having me discuss this paper. I'd like to thank Alan and Danny for a very coherent presentation at what is essentially 5:30 in the morning for them. I'd also want to thank them for producing a great paper to be a discussant of. Sometimes you read a paper and you're not quite sure what angle to take. This paper has two sort of complete sets of results, and then there's this gaping unanswered issue. And as the first discussion, I exercised the option to take the bait and talk about the unanswered issue. First, let me summarize the main results, although they were summarized nicely before. The first result is there was fiscal feedback to deficits in the output gap in what I'll call the first period. All of that stuff went away in the second period. The authors call all the feedback going away, they optimistically call that a wait and see strategy, which suggests that it is indeed a strategy, not just a measure of legislative dysfunction. And it reminds me that when observing Congress or policymakers generally, there's quite often two hypotheses, both of which are consistent with the data. One is that they have no idea what they're doing. The other is that they know exactly what they're doing. And we'll see which interpretation is right in the future. But I think our natural tendency is to think they're just messing up when there might actually be reasons for their behavior the last 20 years. The second set of results are these simulation results. The numbers I put up here aren't crucial. The basic idea is if we don't have any fiscal feedback the next 30 years, we are in a terrible, terrible situation. If we do have fiscal feedback on the order of what we had in the first period or close to that, the situation is mostly better. There are some bad outcomes, but generally the weight of the outcomes shift toward more positive outcomes. So the bad news is without fiscal feedback, we have a terrible situation. With fiscal feedback, we have pretty close to a manageable situation. And then the gaping question is, are we going to get fiscal feedback? That is, why did policymakers change their behavior, and are they going to change back? And before I turn to that, I'll talk about the model a little bit, but I also want to have a kind of a reality check of the numbers we're talking about. The last table Alan showed the deficit going from 2.6 to 1.4% of GDP over the next decade if they follow the deficit-driven feedback rule. Right? In dollar terms, that's $4.2 trillion. Now, Phil said yesterday, economists, or maybe Danny said at a different conference yesterday, economists like to think in real terms. The budget is done in nominal terms. The nominal number there is $4.2 trillion that would have to be cut over the next decade, which to me seems implausible. But debt-driven feedback would only require adjustments only of $1.75 trillion. Okay, so a little bit of background. You've all seen this graph before. Maybe there's an interpretation of it that's a little different in the context of this paper. You can see I've marked off the first period. You can see the rapid buildup of debt and then the pay down of debt toward the end of that period. And then you can see the last 20 years debt has just gone up basically because of the two shocks Alan identified and for other reasons. What is interesting is we're due, in a historical sense, for that debt to GDP ratio to come back down. That seems very unlikely. It seems like if it could be stabilized over the next 20, 30 years, that would be good. But the historical perspective is helpful for showing that if debt to GDP does not come down, it's not just an aberration with the earlier period that Alan studied in his earlier paper. It's an aberration relative to our whole history, right? Our whole history is debt builds up relatively rapidly for some reason, for different reasons in different episodes, and then it gets paid down fairly rapidly. When I say paid down, I don't mean literally paid down. Sometimes it's GDP growth that helps, sometimes it's low interest rates that helps, et cetera. But the ratio is cut in, a rule of thumb would be that the ratio is cut in half after about 15 years after it hits these peaks. And you can see that that's pretty consistent across history. Now, the this graph hides a lot of stuff. The reasons that debt went up in different periods matter, and the way it came down in different periods are different. And the issue that we face right now is, as I'll talk about in a second, we've got these very persistent entitlement spending that's going to push the deficits. It's going to be constant headwinds, essentially, against fiscal sustainability. Whereas in the past, World War II, for example, there was the military buildup, and then it came down. Okay, so let me talk briefly about the model. The model is kind of a standard, I thought, thoughtful and clear extension of standard budget projection models. The authors add two things to it: the economic risk and the fiscal feedback. One thing to note at the outset, when I say a standard budget projection, there's no behavior in the model, right? There's no business cycle, there's no monetary policy, there's no dynamic feedback effects like Doug talked about yesterday. It's basically an adding machine. It's a very sophisticated adding machine, and there's plenty going on in the model to discuss. So it's not a criticism, it's just a comment. But when at a high level, when you add shocks and fiscal feedback, two things happen. When you add the shocks, it turns out that they're non-symmetric. That means that the non-stochastic projection is not a central tendency of budget outcomes. In the tradition of discussing CBO without criticizing CBO, I will say when CBO does its sensitivity analysis, it does it in a symmetric way. So inflation goes up by 1 point, it goes down by 1 point, and interest rates go up by 1 point, down point. That kind of implies that the non-stochastic numbers are central tendencies, but this paper argues that they aren't, and that's an important contribution. The other interesting conceptual thing I think that mattered is the paper shows that R minus G is not that important. And we're not used to thinking that way because we're used to thinking in standard budget models where if R is greater than G, you get this debt deficit spiral and things are really bad, and thank goodness R is lower than G. But when you have fiscal feedback, R greater than G just raises the deficit, and Congress responds by cutting the surplus. So different things matter in a stochastic environment than typically matter in a non-stochastic environment. All right, having said that, I'm going to take the model at face value. I know Valerie's going to go into more details. I'm going to take the model at face value and look at this question about why did policymaker behavior change? And I just want to emphasize, this is not a political science sideshow. This is the whole enchilada here as we're looking forward. I also want to say that I don't know the answer. I'm going to give you lots of potential reasons, but if you come away from this feeling like I answered this question, I have misspoken. Okay, so the obvious places to look. One of the obvious places is changing public opinion about deficits. In a way, this is true. I'll show you at the end something that's suggestive of that. But public opinion about deficits is notoriously fickle and easy to manipulate. It may be that they're changing financial market reactions to deficits. Real interest rates were lower in the second period. Net interest to GDP was lower. And of course, we've all had this experience where we've learned over the last 25 years that there's more fiscal space for the U.S. than we thought there was 25 years ago. That almost by definition means we care less about debt and deficits than we did before. And then there's kind of this notion that, well, you know, things were easier back then in the good old days. There was no Great Recession or pandemic. There was actually a peace dividend from the breakup of the Soviet Union. There was the Great Moderation and entitlement spending, which has shown to be harder to reform than discretionary spending, was a smaller share of the budget. So just some graphical results here. It's very difficult to find a long time series on public attitudes toward the deficit. If anybody has one, please let me know. This is the best we could come up with from Gallup polls. And, you know, the numbers are all over the place. I'm not going to try to pull out a trend here. Real interest rates we calculated in several ways, and they were lower in the second period than in the first period, not surprisingly. Net interest hit a trough in 2004, but generally was lower over the second period than the first period. And the entitlement spending went up from less than half to almost 70% of spending. So the second category of behaviors are more political things. The budget rules that were enacted in 1990 expired in 2002. They were partially reinstated later. I personally am of the view that they are not particularly enforced. They don't impose great constraints, that they mainly, the expiration reflected a pent-up demand for looser fiscal policy. In the first Bush administration, we had tax cuts, we had discretionary spending up as a share of GDP, we had mandatory spending up as a share of GDP. That had almost never happened in earlier administrations. The second possibility is increasing partisanship, polarization, tribalism in Congress. There's a New York Times article that said that no Republican had voted for a tax increase from 1990 to 2012. The article was written in 2012, so presumably farther. But that only makes it hard to do tax increases. It makes it hard to do any kind of negotiation, because if one side won't negotiate about their thing, why would the other side negotiate about their own thing? And then the third thing that comes to mind is the increased prevalence of unified government. In the last 4 administrations, I think we've had unified governments to start out with, and that tends to raise deficits. Clinton was the one exception. The increased use of reconciliation for deficit-increasing policies rather than the original purpose of deficit reduction could also play into this. I don't know. This is just a graph that shows you what you know, which is that partisanship has increased. Finally, I want to turn to the true reason this all happened, which is on January 10th, 2004, the New York Times reported Dick Cheney's statement that Reagan taught us that deficits don't matter. And that's perfect timing to explain the 20-year shift in Allen's papers. And all we needed to solve this problem is for Cheney to say publicly that deficits do matter. But obviously tongue-in-cheek, but this is a noticeable contrast from 10, 12 years earlier, where Rubenomics was pushing the Clinton administration to cut the deficit, to lower interest rates, to boost the economy. And to 2 years before that, where, believe it or not, Ross Perot won 19% of the vote on a largely anti-deficit platform. So there does seem to be a change in the ether, a change in the public opinion about this, but it'd be nice to be able to pin that down in a survey. All right. So the key question is, will policymakers change their behavior? And some of the causes of behavioral change seem temporary to me. Some seem permanent. On top of that, you've got the issue that the underlying fiscal problem is different than it used to be. We didn't just come out of a recession. We didn't just come out of a war. We've got this long-term spending built in. So the paper, I think, has really helped us understand several aspects of the fiscal situation. Thank you.
Second discussant is Valerie Ramey.
Thank you. All right. Well, thank you for asking me to discuss this paper. I learned a lot from it. So initially I said, what new can be said about the dismal fiscal situation? But leave it to Alan and Danny. They really looked at this and rigorously confirmed what we suspected, which is the situation is bad. Nobody is doing anything about it, even though they used to. All right. So they not only do look at different kinds of fiscal rules, but they look at them with full certainty, but then show what happens once you get shocks like pandemics and those sorts of things. So they did such a good job on their presentation, and also Bill summarized some of it. I'm going to skip my first 2 slides. I'm going to talk about 2 main things. One is thinking about fiscal feedback, and the second thing is going to be a case study of how the U.S. reduced the debt to GDP ratio by 30% in the 3 years after World War II, if I get to that. Okay. So let's just think a little bit of background. This is, the kinds of things that this actually follows to some extent the Blanchard, Leandro, and Zettelmeyer paper. So let's think about debt dynamics. So B is the debt to GDP ratio. S is the primary surplus to GDP. R is, let's call it the real interest rate. I'll do things in real terms. And G is the GDP growth rate. All right. So the change in the debt is going to be equal to what they call the excess interest rate term, R minus G over 1 plus G, times the lag debt minus the surplus. All right, so that's basically an identity. Now, Henning Bond, back in 1998, when nobody was really caring about fiscal stuff, came up with what's the foundation of what we still talk about today, which is he estimated over a long period of time that there did seem to be a feedback rule, that primary surpluses relative to GDP were equal to a constant, which is related to the initial surplus. And then there was a feedback from the lag debt to GDP ratio. So that D parameter is really important. So he estimated something that wasn't zero. And then he says, but you can have cyclical things like responses to the output gap. But the key was that cyclical thing had to have mean zero. All right. So remember that. Remember how their effects is a ratchet upward, always positive shocks. Now, if you plug that feedback into the debt dynamic equation, then you get a particular path of debt dynamics that allows for this feedback. And the interesting thing, and of course this is what Olivier Blanchard was emphasizing, is that what matters is that term, the excess interest rate term, the R minus G term, minus D, where D again is that parameter on the feedback rule. And it turns out, if you have complete certainty, if that D is greater, so the strength of the feedback is greater than the R minus G term, then the debt ratio will never explode. Now, this doesn't mean it won't go above 250%, it just means it won't explode. Now, contrast that to what Auerbach and Yagan talk about. So the bond rule says you've got to respond to the lag debt to GDP ratio. This is the correct feedback if one cares about the debt path. Going back to optimal control again, you've got to have the state variable in there. Now, the Auerbach and Yagan baseline rule has primary surpluses respond to the CBO's forecast of the primary surplus GDP ratio over the next 5 years. There's no debt feedback in their baseline. And I kept saying, why did they exclude this? These are smart guys. And then I realized it's not really fair to call it the Auerbach-Yagan rule. It's what they estimated in the data. Even in the earlier period, you get a zero on debt. And so then I said, aha, that's why they're actually simulating something that's more realistic. In neither period did it respond to the debt GDP ratio. Okay, now contrast this again. Let's go back to that bond rule. It actually turns out that even if D is equal to zero, there's no feedback from debt. It's okay in terms of explosions of debt GDP as long as the real interest rate is less than G. All right, and that was the whole idea of the R minus G. But this isn't the case if we account for at least two other realistic features. There are probably more ways to look at this. One is, suppose there are political or economic constraints on the primary surplus, or suppose that there's shocks. All right, so I'm going to talk about these constraints first, and then later I'll talk about shocks in terms of their stochastic simulation. So as Blanchard and I'll talk about, if you have some upper limit on how much of a primary surplus you can run for political reasons, for fiscal reasons, then suppose that's S bar. Then the maximum sustainable fiscal debt is given by this equation, the S bar times actually the inverse of that excess interest rate ratio. So that means suppose that the maximum that you can politically run for the surplus is 1.5%. And suppose that R minus G is 1.5%, so R is a little above G in this example, then the maximum sustainable debt is 100%, all right? So this helps us think about it with constraints. Now, before talking about the uncertainty, let me just talk about their models and simulations. So first, they go through these different rules and combinations of those rules. They first look at it under certainty. You saw a lot of those graphs. But then they start looking at what happens when you look at shocks and allow for shocks to various elements of the rule. And then you really get the probability of unsustainable paths using the post-2003 estimated rule to be unacceptably high. Now, there are two things that they omit in their simulation. I mean, so their simulation's nice, but I'm just giving you an idea of how things could be even more pessimistic, all right? So first of all, I mean, nobody would expect me to talk without talking about multipliers. They actually assume that multipliers on both spending and taxes are zero, all right? So there's debate about the magnitude of them, but most people don't think they're zero. And evidence suggests that on average, fiscal consolidations are painful, right? They reduce GDP. This is why, the Congress doesn't want to do fiscal consolidations. The second thing is that their stochastic processes don't allow for covariances, and let me explain why that's important. It has to do with that shock that's trying to, pick up that ratchet effect, but then I'm going to talk about another kind of shock. So suppose we have a model in which news arrives of a secular decline in GDP growth. So that G in that excess interest rate term, say, falls to a lower level. So we have a growth slowdown. We've experienced those before. Likely consequences, if you've ever worked through one of these models where you get news of a growth slowdown, persistent or permanent, you're going to get a recession in the short run typically because how consumption and investment will respond. That means you're decreasing GDP in the denominator, the debt GDP ratio. But of course, government, maybe because somebody says, oh no, secular stagnation, we need to stimulate the economy, starts doing a debt finance stimulus, and that increases the debt. So both the denominator's going down and the numerator's going up. Now, although the stimulus is temporary, hopefully, the debt GDP ratio doesn't decrease because that lower G raises the excess interest term. In this scenario, the shocks to Auerbach-Reagan's debt and excess interest rate equations are correlated. That means that the risk of explosive debt paths is even greater than what their simulations show. And an example is if you look at that nice graph they have of the excess interest rate, you'll see that R was way above G during the Great Depression around that time. And geez, there it is right during the Great Depression that you get this bad excess interest outcome. Well, was that bad luck or was it correlated shocks? Well, a standard dynamic model will tell you that it wasn't bad luck, it was correlated shocks. Of course, the problem is that when you get those shocks, raising taxes or lowering spending in these bad states is particularly painful. That's why you want to try to do these fiscal consolidations when the economy is doing well. Let me not do this. So, actually, I do have that. Oh, the presence of shocks is also really important for this feedback, whether it's deficits or debts, okay? So the rule implies that the government, if you just use the deficit rule that they estimate from the data, they ignore the effects of past shocks. Pandemic, yeah, sure, we raised the debt, but we're not going to pay attention to that. Great global financial crisis, we're not going to pay attention to that. They just care about what's happening now. So you just keep getting these ratchet up effects. And in fact, their simulations show there's no parameter value in the deficit feedback rule that guarantees that the debt GDP ratio remains under, I think it was 200% with 95% probability. All right, I am pessimistic about fiscal reaction functions going forward. Let me just say briefly, for this part, before, a lot of the spending was due to things like military buildups or infrastructure projects. Those had a life cycle, all right? Even the Cold War. In contrast, entitlements are forecasted to just keep growing because of aging. Also, Congress, when they do things with entitlements, they almost always make them more generous. They rarely, I couldn't even find a case where they significantly made them less generous, all right? So going forward, I see even less feedback simply because of the type of spending. So let's look at one of the cases where debt to GDP was as high as now, which was, of course, after the end of World War II. So this shows a graph of revenues in the blue line, or sorry, outlays in the blue line, revenues on the green line. And the lines there, the first one is the end of World War II in mid-1945, and the second line is the start of the Korean War, okay, because there was a war just 5 years later. And the Korean War looks small here, but that's only because I have World War II on the axis. If you do post-World War II period, Korea looks huge relative to Vietnam and anything else. All right. So let's look at 1940 and 1950. Public debt goes way up and then comes down. This is debt to GDP ratio. Now, part of it was the primary surplus. They managed to start generating a primary surplus soon after the end of the war. But then look at the third graph. That's the GDP deflator. They had all those price controls on during World War II. They lifted them, and the price level shot up 30%, almost 30% in 3 years. So I actually did a decomposition. What exactly was reducing that debt to GDP ratio? Turns out the surplus simply compensated for the decline in GDP when you're coming down from World War II. So those cancel out. So the entire fall was due to the inflation tax. So I keep forecasting higher inflation in the future, knowing these incentives. Tips aren't, but I think that could be a big issue. So anyway, this is a really neat paper. So I've talked about ways basically that it could be extended, not flaws in the paper, but ways that it could be extended. And I think what they've done here is really important. And all I can say is gone are the days of leaders and candidates who cared about the deficit. And I have Truman there because he financed the Korean War with taxes.
Thank you so much. I'm actually going to exercise my prerogative and make the first comment myself this time. I really liked it how Bill brought in the historical perspective for the United States with the figure all the way back to the founding of the Republic. And it looks like a very well-behaved series, as Bill described. Things go up really fast during wars and then come down really fast after wars. Now, I think another historical example is also instructive, which is the UK. If you look at the same figure for the UK, which you can do back to about 1700 actually, it looks way, way less benign. It's a really, really ill-behaved series. It keeps going up and up and up and up for 100 years, from 1700 to 1815. And it's just slowly, and there's really nothing in between the wars that's going down, and it just looks like it's going on forever. And then for 100 years, it just goes down and down and down and down and down. And that's under a gold standard, no inflation. So, I'm scared about this too, but, short samples can be kind of deceiving, I think, in this context. Jason.
So 4 comments, not counting that this is an incredibly terrific and exciting paper. The first one is, as much as we like to look down on the political system, we're the people who were even worried about the debt when it was 35% of GDP, when it was 50% of GDP, when it was 70% of GDP. Now it's 100% of GDP. The 10-year is less than 4%. The economy is growing at 3%. Maybe Trump and Biden-proof deficits don't matter. Second point is, it is possible that the fiscal system's reaction function is to something like real debt service. And now you might ask, why would they have a reaction function to something Larry and I proposed a few years ago? Part of why we proposed it was eyeball empiricism that looked at that series in the past, not systematically like you did, so I'd love to see it systematically. And it looked like when that went up, people did a lot. And when that was low, people did very little. And maybe that's what they were reacting to. The fact that your sample doesn't work well since 2004, we've been at the zero lower bound for 50% of the time since 2004. The consequences of deficits are very different at the zero lower bound, and potentially the need for them and the need to remedy deficient demand is very different. And so maybe that reaction function should be different. Third point is, if you're rational and time consistent and you two are in charge for the rest of time, you could obviously come up with better rules than the one you had. You could avoid the 5% tail risk with things that were more nonlinear and do even less now. But my final point, which goes a little bit against the spirit of all my others, is that policymakers, notwithstanding what I began with, probably aren't fully rational and fully time consistent, not up to the standards of the two of you. And in that respect, I was actually surprised that you came down for a rule that would have much less deficit reduction over the next decade than I would suggest. I would be aiming for something like primary balance, debt declining as a share of GDP. Yours works if you stick to it forever, but if at every sort of decade you reset and expect someone else to do it, it won't, and it loses the type of anchor that either primary balance or declining debt would give you.
Doug?
Thank you. A really interesting paper and discussions. My comment builds a bit on some of what Jason said. As I think back to the 80s and 90s and what worried people about budget deficits and I think caused them to support people like Ross Perot, it was a view that deficits raise interest rates and deficits can raise inflation. And so we've had over the last few decades consistently low interest rates and consistently low inflation. So the triggers that got people worked up and then caused them to lean on policymakers to take actions really haven't been there. Now, it happens the last few years, we've had big deficits, we've had some increase now in interest rates, we've had some higher inflation. I'm not saying those are all totally causally related, but I think that's an example of the sort of phenomena that if it recurs in the future might be the thing that would cause policymakers to cause the public to react and then cause policymakers to react as well. Thank you.
Neil and then Debbie.
So this is both, I guess, a question and a comment. Just to understand a little bit more, what is your assumption about the response of interest rates to higher debt to GDP? The CBO makes a particularly stark assumption that dominates their out-year projections, where every percentage point of debt to GDP raises the real interest rate by 3 to 4 basis points. There's not a lot of great empirical evidence on this. You go to the Laubach paper, which is one of the better empirical work in this area, and those estimates are unstable. They actually, if you extend the sample, the coefficient becomes insignificant. And in structural models, structural OLG models, you can get substantially smaller effects of increases in the debt to GDP ratio. So that seems to be quite important for thinking about debt sustainability, and be great to hear more.
Two comments. One reason that hasn't come up, which I think makes the growing debt even scarier, is that it's happening all over the world. And we don't know how triggers in other countries could spill over to us and vice versa. But in any case, I thought the analysis was fascinating and wonder if you or maybe your students could be induced to look at the time series in other countries. John alluded to the UK, but I mean, it would be interesting to see if in places where there have been these growing pressures, maybe even more severely than in the United States, how those countries responded to it. And then secondly, just to make a quick comment on the interest rate, you know, it won't always be a risk-free rate. So when we think about that correlation, when debt gets very high, at some point there's a risk premium, and that can really accelerate the pressures. And I wonder whether you've considered feeding that into your model.
Henry Aaron?
First, a point of correction for Valerie. If you're looking for a cut in entitlements, go back to 1983, when Social Security was significantly cut to restore balance, along with some tax increases, but it was mostly a cut in benefits. I have to say, I find this session and the body of work peculiar. I am reminded of Orthodox Jews who do numerology on the Talmud in order to predict current events. Nobody in the course of this session has uttered the word tax, not once. And yet, that is a major actor in the story. And what is behind that story is a set of political commitments and actions. We are economists. We're going at it with the tools we have. Give a kid a hammer, everything looks like a nail. But the roots of this problem are not in the numerology. It's in the politics. I'm not suggesting that the forces that are being discussed here are irrelevant in shaping the politics. But it seems to me that an examination of that process is the key to understanding where we are and where we are likely to evolve. And that the numerology here really doesn't provide us a lot of guidance. I realize this is out of step probably with everybody else in the room, but I think that comment needed to be made.
Ethan.
My comment may be a little bit in step with that. So I view this type of question in three layers. One is the type of empirical reaction functions and debt sustainability exercises that you've conducted, and I think they're extremely useful and also very well executed. I would say the next layer that I would think of is fiscal rules that try to enforce the type of behavior that we would like to see. Now, I'm actually very skeptical of that second layer because when we look around the world, there are many countries with fiscal rules, but there's almost no correlation and no evidence that those fiscal rules actually bring down deficits, let alone lead and may even have some other negative side effects. And so when we ask why are fiscal rules ineffective? That's because those same legislators that set the fiscal rules are the legislators that can change them, and are the same legislators that want to run deficits can change the fiscal rules at a whim. Which brings me to the third layer: what are the fiscal institutions that enforce those fiscal rules? And I think where fiscal rules do work. Actually, it doesn't matter if it's a formal or an informal rule, is where there's an institutional structure that enforces fiscal discipline. So insofar as there's been a change in the past 20 years, and Valerie put a little bit of skepticism on there actually having something change, but if there has been something that changed, I would want to hear more about what is it that's different this time than in the past. What has been the degradation of the fiscal institutions, the politics? Is it entitlement? So I think this synthesizes a lot of the other comments that has changed in the past 20 years relative to the previous periods.
Jonathan.
Yes, so this goes a little bit to Bill's unanswered question and Doug's trigger. You never know what's in term premium, but it was surprising last November at the Treasury's refunding announcement when the Treasury changed the composition of their planned issuance, and the 10-year yield moved quite abruptly, and the ACM term premium model fell 20 basis points on that announcement, which was a very surprising degree of sensitivity of financial markets to the supply of duration. So, that's something that we haven't seen in financial markets, to Jason's point, in a few decades, but this may be something that we need to think about going forward.
Maury?
Yeah, just three points. The first one is actually related to the last comment, which is, to what extent do you think about the maturity structure of debt? Does that respond systematically to deficits or the level of debt? Of course, this is going to affect the way that various shocks feed through to the deficit and debt levels, and could be potentially important. A second point relates to the intertemporal budget constraint in a setting where you're not following a bone type rule. We talk about debt levels reaching 250%, 300%, but ultimately it's the intertemporal budget constraint that has to be satisfied, and if markets think it's not being satisfied, then interest rates will adjust endogenously. And the kind of jumps you have could be thought of as confidence crises, but these potentially would be functions of what the markets see going on in Congress with debt levels. Finally, John Steinson's point about the UK and the gold standard put me in mind of a seminar we had at Berkeley a couple of weeks ago, Bank of England economist named Oliver Bush. And what he's done, I don't think the work is published yet, but he did a kind of Romer exercise with statements of the Chancellor of the Exchequer, the budget speeches in the UK Parliament. And he finds that in the gold standard period, when, as John pointed out, these debt levels came down, the chancellors would explicitly mention that policy was responding to the high level of debt. And I think that's a key component. They're basically following a bone rule, and that ceases later in the 20th century.
Joe.
Yes, thank you. So as you can imagine, we have pension funds are part of our client base, and they're kind of interested in this question. And so they ask me for a prediction about what is going to change or what happens. And I channel my inner Clubber Lane and say, prediction? And they say, yeah, well, we would like to avoid the pain. And so I would invite, and I guess the point of the paper is it used to be the case that we would have predicted pain, and that was what would get us off the, get the Congress working. And now it's probably, at least my prediction seems to, Valerie seems to agree, is that it's going to be actual pain. And so I would just invite some sort of conversation as to the extent and what type.
Wendy?
I want to talk a little bit about what I think the relationship is between inflation and deficit. So with a credible independent Fed, predicted deficits going forward shouldn't be inflationary. We should only worry, perhaps, about unanticipated increases in the deficit if we're going to think about inflationary effects. And so then you might think, but what about strategic inflation? And, you know, work by Bill Gale and Louise Chainer has convinced me that this is not like the World War II episode where inflation solves our problems, because our problem isn't really so much the stock of debt. Our problem is projected deficits going forward. And inflation can help us with the stock of debt, but it's going to make it much harder to finance our deficits going forward. So strategically, inflation doesn't really work. But then you might say, so which gets me to, like, then what's the risk premium that we're worried about? I mean, I don't think the risk premium is really inflation, because I don't think, at least if we're being strategic, that solves the issue. So then is it default? Well, default has the same problem. Default cuts us off from financial markets. And again, our problem isn't completely the stock of debt. The problem is, under current law, and most certainly current policy, we need to finance a whole lot of borrowing going forward. So default doesn't solve that either. So, you know, anyway, I'm not sure what that risk premium is supposed to be reflecting.
Mark?
It's a great paper. I want to give a couple suggestions for more work for you all. The one is just to, I think, say explicitly what Doug and Jason did implicitly, which is you should try this again with a interest cost feedback, maybe also interest rates and deficits. The second is when you're looking at legislative changes, it looks like you're looking at CBO's sort of legislative changes section of their biennial baselines. That includes extrapolations of one-time discretionary spending that may be messing with your numbers a bit, especially during the global war on terror period. So I'd encourage you to see if removing those changes the outcomes at all.
David.
So this is all really interesting, and I want to start by underlining the point that Bill made, and then Henry Aaron reiterated that the political science side of this is not a sideshow. It's fundamental. And this being Brookings, people are usually pretty free about doing some armchair political science. I haven't heard much, so I'll do a tiny bit of my own, which is It feels like a game of chicken, and you're not playing a game of chicken optimally if you aren't running some risk of the disastrous outcome. So if you do the thought experiment, so as you went to either Republicans or Democrats and said, things are going to be fine, we're confident of that, then whichever side it can be, say, okay, well, great, we're not going to concede on spending our taxes, as the case may be. So my incredibly simple first step model of the political side says there has to be a strictly positive chance of a disastrous outcome in the current political environment. And I think if I tried to calibrate that model, I'd end up with more than strictly positive.
Robin.
Question and a comment. Danny, question for you, I guess. When you talked about the calibration of the shock, you were talking about excluding the Great Depression and World War II. I mean, this is implicitly, I think, an assumption on the periodicity of the shocks. So how sensitive are your results to that? I sort of was listening to Valerie, and I was thinking we should include those excluded episodes. And so presumably that would increase the vulnerability of the whole exercise. The comment is that, and this goes back to Jason's point and something that Brian Sack was talking about yesterday. I mean, we have a number of bond market accidents globally that are happening that I think without central bank intervention would be resulting in substantially higher interest rates. Think about the Treasury market blow up in March 2020 at when COVID first hit. The Fed did huge interventions. Think about the ructions in periphery debt markets in June 2022 when the ECB introduced a new facility to buy periphery debt with no strings attached. Think about the LDI blow up in the United Kingdom in September and October 2022. So, I'm just saying the obvious, which is there's an obvious monetary policy angle here, and we're suppressing the interest rate signal.
Louise.
Yeah, I just want to follow up on the political economy thing, which is I think what's going on here is until the public actually cares about deficits, you're not going to do anything, because even if you're like a good government person, like I want my priorities, but I'm going to pay for them, well, that's just going to create room for the other side next time to have a big tax cut. So it's foolhardy to do it on your own. So both sides have to get to the point where they agree, where you actually think a compromise isn't just going to be where you're losing in a longer game. And I do think it's something like interest rates. It's something that gets the public there, and then the politicians will respond, but not till then.
Okay, let's hand it back to the authors.
Is there a button? Oh, yeah, it's on. We got a lot of great comments here, and we thank you for them, particularly our discussants, Bill and Valerie. It's notable that they both mentioned Ross Perot. I don't know what to take from that. Just on the macroeconomic cyclical fluctuations, which we suppressed in the analysis, and which Valerie pointed out. I mean, just a couple of points. First of all, in the estimates that we did of the deficit feedback rules, there is a GDP cap term, and the pictures that excuse me that Danny showed had that taken out to produce residuals. So we certainly recognize that the deficit reduction, even if necessary, is unlikely to happen and shouldn't necessarily happen when the economy is weak. In terms of how that omission affects our model, I mean, we're really thinking about a longer-term model, and I guess you would say that we're sort of assuming that these fluctuations and the deficit responses to normal fluctuations, not these big debt shocks, are sort of canceling out and therefore not really affecting the long-run trajectory very much. Neil asked a point about how responsive are interest rates. I think that came up again. How responsive are interest rates to the debt in our simulations? I think I mentioned sort of very quickly in passing that we're sort of trying to mirror what CBO is projecting over the next 30 years. Specifically, what we end up with is a sensitivity of effectively 0.8 basis points per percent change in the debt to GDP ratio. That is smaller than CBO's current approach, which I believe is 2 basis points per increase of percent in the debt to GDP ratio. And I've learned that really is, as we suspected, reflects the fact that there's more in their model affecting interest rates than the debt to GDP ratio, and things like demographic change are pushing interest rates down. And so the increases that we're measuring relative, in interest rates relative to increases in the debt to GDP ratio are actually understating what's in the CBO model for that partial relationship. So to the extent that you think that CBO's estimate of 2, coefficient of 2, or their previous estimate that was higher than that is a bit too high, then we're not incorporating that full effect, and we're not even sure, whether we should do. Maybe perhaps we've been thinking maybe we should do more than we're actually doing. On a lot of the politics and what's changed, I certainly agree with Louise's point. That if the other side does it, she worked in the Clinton administration and remembers all those surpluses that they handed over to George W. Bush for his tax cut. Probably has that in mind. But that, in a sense, doesn't answer why things have changed, because it was in 1990 that the first George Bush, in conjunction with the Democratic Congress, did engage in substantial budget cuts. So something changed. Obviously, you need both parties to play, but we don't know why they stopped. It could be polarization. It could be that with interest, as Bill suggested, with interest rates falling, maybe people are less convinced that deficits matter than they used to be. And it's really hard to say. And I agree with you, and I agree with Hank, and with everybody else who highlighted the politics. I guess to Hank, I would ask the following thought question. Okay, in 1983 we had entitlement reform. We're going to need something in the next decade of a similar nature to deal with Social Security running out of money. How much would you want to wager that we don't engage in anything that increases Social Security taxes, raises the retirement age, or cuts Social Security benefits, but instead uses general revenue funding? And I think, to me, that illustrates that there's been a change in the environment. And yeah, we were able to do it in 1983, and we were able to do it in 1990, but doesn't provide very much comfort for the current situation. I think I'll turn it over to Danny for the remaining comments.
Thanks, Alan, and thank you, everyone, for your comments. First, to Robin, yes, the estimates are sensitive to the number of the sudden deficit disasters, and it's art more than science. It's more art than science of what your average number per century is. To tie a few comments from Jason and Neil and others, we deal with 2 types of uncertainty in the paper. Those deficit disasters, and then what are your shocks to this AR1 process for the excess interest rate? There's other uncertainties that are very hard to model. What is the central tendency of the excess interest rate over the next century, even holding constant the debt to GDP ratio? There could be unexpected changes in global demographics that move it up or down. That's very challenging to model. What is the reaction function of what's the feedback of the debt ratio into the excess interest rate? Is it linear? Is it nonlinear? The estimates are all over the map. In one of our regressions, the sign is wrong on the debt to GDP ratio when you regress the excess interest rate on the debt to GDP ratio in just a simple regression. So this links into what Jason was saying. You economists told us not to breach debt to GDP of X and Y and Z, and look, interest rates have come down. So let's just wait and see. And part of what we wanted to do here was actually what would a wait and see strategy look like under certain plausible shocks. And actually, that type of, in talking to the political participants, one hears that. So we've heard a version of that in the political strategy. Why cut the deficit now if you're just going to blow it up in the next term when the party changes hands? Another version of that is an economic uncertainty version, which is, why should I raise taxes now or cut Medicaid now for some uncertain benefit of from the fiscal envelope over the next 100 years? And to bring this back home, Peter Orszag, and I think in Brookings a year ago, OMB director under President Obama, I believe known as not a deficit dove, said, hey, you know what? Climate change is a risk that we can't just in 30 years decide to start taking seriously. But in 30 years, if there's a fiscal crisis, we actually can do a fiscal consolidation and then fix it immediately. So if forced to choose, I will trade one risk for the other. And I do think that the political constraints, the political science is obviously first order, and I think it's also useful to follow the, what uncertainties are the participants trying to take seriously.
Okay, let's break and start up again at 10 a.m. Okay, I think we should get started with the second session, which where Pascal Méchard is going to present a paper with a wonderful formula title, U star equals square root of UV. I love this title. A lot of the comms people were a little more skeptical. Take it away, Pascal.
Yes, thanks for inviting us. All right. This is a paper about the full employment rate of unemployment, or FERU, in the US. And what we are doing in the paper, it's try to figure out what is the level of full employment in the United States. And what we'll show you is that the FERU, which we denote U star, is given by the square root of U and V, where U is the unemployment rate and V is the vacancy rate. So the first step in trying to figure out what is this FERU, what is full employment, is to translate the legal concept of full employment into economic terms. So first, where does this concept of full employment come from? Why do we have a full employment mandate? So the first time that this was brought up was by the Employment Act of 1946. So after the Great Depression and World War II, then this was reaffirmed with the Full Employment and Balanced Growth Act, that's 1978, and full employment or maximum employment was also mentioned in the Federal Reserve Reform Act of 1977. So in these three acts, basically the law says that it's the mandate of the federal government and the Fed to try to maintain the economy at full employment. But the law doesn't really say, what is full employment. There is no definition of full employment in there. However, if you look at the text of law, what you see is that it's always talking about how full employment is going to be good for welfare, and how being at full employment is going to, maximize well-being. So here, the way we translate full employment is very straightforward. We're going to say that full employment is just social efficiency, and therefore the FERU is going to be the rate of unemployment that's efficient. So that's how we are going to interpret. That legal mandate. Now, how are we going to compute this efficient rate of unemployment? So that's pretty simple. So let me show you the derivation. So we consider a social planner that's trying to maximize welfare. So how do you maximize welfare in this type of model? So here what we have in mind are modern models of the labor market. Well, you have to maximize output, and to do that, what you have to do is minimize the non-productive use of labor. So what are the non-productive use of labor in this model? There are two sources. There are two forms of non-productive use of labor. One is, of course, unemployment. And of course, there's a bit of a question as to what unemployed workers do exactly. So they are looking for jobs, but they might have time to do some home production or to relax. But in practice, what you see in the data is that the psychological cost of being unemployed actually offsets any value from home production into unemployment. So here we're going to assume that, all the unemployed, they do not contribute at all to social welfare. So as a result, the unemployment rate U, it's going to be something that just doesn't contribute anything to social welfare. So that's going to be something that the social planner wants to minimize. The other non-productive use of labor in this model is recruiting. So workers, when they're employed, they can produce stuff that contributes to welfare, or they can be doing recruiting, so trying to hire new workers that are going to come into the firm. So if you think about academics, you can spend your time doing research, or you can spend your time recruiting new colleagues. And in practice, you divide your time between two things. But when you're doing recruiting and attending job talks and reading CVs and reading job market papers, you're not doing research, right? So it's taking time away from production. Now the challenge is, how is it that we're going to measure the number of recruiters in the economy? Because unfortunately, that's not something that's yet in government statistics. But what we see in the data is that roughly you can measure the number of recruiters in the economy by the number of vacancies in the economy. Because in practice, in the data, it takes one worker to look after one vacancy. So to measure the number of recruiters in the economy, we are just going to look at the number of vacancies in the economy. So as a result, that's why we are saying that the social planner wants to minimize U plus V, the unemployment rate plus the vacancy rate, because these are all the people who are idle or doing recruiting. Now, if you want to minimize U plus V, it's pretty simple. What you could say, well, this is a very trivial problem. We'll set U to 0, V to 0 will be done. However, that's not possible. Why? Because there is a Beveridge curve in the background. And the Beveridge curve tells us that we cannot reduce both U and V at the same time. And in fact, in the US, the Beveridge curve has a very simple shape. It's an hyperbolic, it's an hyperbola, rectangular hyperbola. So the product of U and V is always equal to a constant. So because of that Beveridge curve, you can't just set U and V to 0. You have a trade-off between the unemployment rate and the vacancy rate. And in fact, here on the slide, you can see the first order condition that solves this planner's problem. So we're just trying to minimize U plus V subject to U times V is equal to A. It's the same as minimizing U plus A over U. You take the derivative of U is 1, derivative of A over U is minus A over U star. You set that to 0. What you get? U star is equal to square root of A. So what you see from here is that the efficient unemployment rate in this simple model is just given by the square root of the location of the Beveridge curve. So the location of the Beveridge curve is what determines the FERU here. And then, because we want to have a rule that's very easy to use for policymakers, we don't want to have A in there, but we know that A is always equal to U times V, so you can get A out, put U times V in there, and you get that the FERU is a geometric average of the unemployment rate and the vacancy rate. So that's where this formula comes from. So now, you know, if you don't even want to take a square root, actually, just from this simple result, you can get a very easy-to-use criterion to figure out whether your labor market is at full employment or too hot or too cold. How do you do that? Well, it's pretty simple. So full employment means your unemployment rate is equal to U star. But U star is square root of UV. So at full employment, U has to be equal to V. So you can keep track of the unemployment rate, you keep track of the vacancy rate. When the two are equal, you know they're at full employment. Then by the same logic, if the unemployment rate is above the vacancy rate, you know that your economy is too slack. If your unemployment rate is below the vacancy rate, you know that your economy is too tight. All right, so now let me show you what happened if we look at US data. You know, how is the US economy doing? All right, so we can go back to 1930. So we have data for unemployment and vacancies going back to 1930. So this is data where there are many, you know, primary sources, but Petrosky, Nadeau, and Zeng harmonize them and put them all together. So here you can see the unemployment rate. This is all going to be on a log scale because the fluctuations in unemployment and vacancy over the past century are so wide that if you don't use a log scale, you're not going to be able to see anything. So we put everything on a log scale. So here I'm just giving you the primary sources. Before 1948, the unemployment rate was computed by David Ware. After 1948, this is just BLS data obtained from the CPS. Vacancies, you have three different sources. Before 1951, it's a MetLife help wanted advertising index. Between 51 and 2000, it's a conference board help wanted advertising index. And then since 2001, the BLS is computing vacancies through the JOLTS. All right, so the first thing you should notice is that, so you see here, the unemployment rate and vacancy rate, of course, they move in opposite direction. When unemployment goes up, the vacancy rate goes down. That's because we have a Beveridge curve in the background. But something else you can see on this log scale is that actually unemployment rate and vacancy rate, they describe this nice butterfly pattern. They are very symmetric. And that's because the Beveridge curve is an hyperbola. So when unemployment goes up by 1%, vacancies go down by 1%. That's why you have this nice symmetry. And also, you know, we have many different data sources here, all put together, but still it's quite a clean pattern. So what do we learn from that? Well, one first obvious finding just from this graph, you can see that the unemployment rate is almost always above the vacancy rate. So what this is telling you is that your economies in the US, it's almost always too slack. We are not at full employment, we're inefficiently slack. However, there are a few rare episodes in which the unemployment rate is actually too low. And what's quite interesting is that these episodes are not random. They correspond to very specific historical events. So you can see here on the graph any any orange area tells you that the economy was inefficiently hot. And you can see they correspond to the major wars that the US fought. So you have World War II, where you had a labor market that was too hot. Then you have the Korean War. Then you have the Vietnam War. And then the last event is actually the recovery from COVID. So in that, the last few years have been quite exceptional because we had never seen really a peacetime episode of inefficient tightness in the US. But that's something we've witnessed in the middle of 2021. So this is the state of the labor market. Now from this, you can very easily compute the FERU. So I told you the FERU, so it's square root of UV, the geometric average of the unemployment rate and vacancy rate. But here, because I'm on a log scale, actually my FERU is just going to be the midpoint between the unemployment rate and the vacancy rate. So here we have the FERU in the US. And what you can see is that although the unemployment rate fluctuates a lot, the vacancy rate fluctuates a lot, the FERU is very stable. So the average for the FERU is 4.1% over roughly the last century. It's always between 2.5% and 6.5%, so it's within a fairly narrow band. And the last reading here is 4.4%, so that's U star as of the second quarter of 2024. So now, from that, you can infer what is the unemployment gap, so the gap between the unemployment rate and the FERU. And that unemployment gap is, of course, very countercyclical, because the unemployment rate is very countercyclical, but the FERU is very stable. So here I'm showing you a few readings. So this is the unemployment gap. You can see it's almost always positive because the economy is always almost always too slack. Of course, the biggest unemployment gap was during the Great Depression, no surprise there. The unemployment gap was above 20 percentage points. Then, the Volcker recession, the Great Recession, you have unemployment gaps around 6 percentage points. And the pandemic, it was a short recession, but again, the unemployment gap was above 6 percentage points. So these are quite large deviations from efficiency or from full employment. And I think here you can also see, the unemployment gaps on the negative side when the economy was too hot. And here you can see that during the pandemic, the unemployment gap was very negative, minus 1.5 percentage points. So it's something we hadn't seen since the end of World War II. So really conveying this idea that the labor market in the recovery of the pandemic was extremely hot. All right, so now what I want to show you quickly is how our measure of full employment differs from measures that the Fed often use. And there are two such measures. So one is, of course, the natural rate of unemployment that the CBO produces. And you can see our FERU is usually below the natural rate of unemployment. Actually, it turns out that they coincide right now. They're exactly at the same level, but that's just a coincidence. You can also plot the NERU. And so this is the NERU that was computed by Richard Crump and co-authors. So they had a Brookings paper a few years ago developing a method to compute the NERU. You can see our FERU is also almost always below the NERU. So, if the Fed use, of course, the NERU or the natural rate as targets, then it's no surprise that the labor market was always too slack, according to our measure, because according to us, they used targets that were just too high. They were not ambitious enough in thinking about full employment. I should also say, of course, so the NERU and the natural rate of unemployment, we don't think they are good measure of full employment. So the NERU is all about price stability. It's about the price mandate. It has nothing to do with the employment mandate. The natural rate of unemployment is computed by assuming that in 2005, the labor market is at full employment. But of course, we don't know, without a theory of full employment, we don't know whether the labor market is at full employment or not. So we don't think these two measures are actually a good measure of full employment. All right, I have 2 more minutes, so let me show you 2 extra slides. One is that here I showed you the representation with unemployment rate and vacancy rate, but actually, if you need just one variable that summarizes everything, that's labor market tightness, the ratio of vacancy to unemployment. So here I'm showing you again on a log scale the labor market tightness in the US, so it's the vacancy to unemployment ratio. Full employment appears very easily here because full employment is when you have as many vacancies as unemployed, so it's a tightness of 1. And so when labor market tightness is below 1, you know that you're too slack. When labor market tightness is above 1, you know that you're too tight. And so here, this is what we have. You can see all the episodes I mentioned earlier. They appear very clearly on this graph. And it's quite interesting. If you look at the end of the graph, you can see what happened during the recession, that followed during the COVID recession. So we had a big drop in tightness. We had a very rapid recovery. And then we go back to something that the roamers discussed yesterday. So actually the labor market reached full employment around the middle of 2021. And then tightness kept rising to reach a level of 2 in the middle of 2022, which is a tightness level we hadn't seen since the end of World War II. And so you have again this period between middle of 2021, middle of 2022, where, so yesterday we saw that inflation was too high. Here I'm showing you that the labor market was too hot, and yet the Fed didn't do anything. They waited until the middle of 2022 to raise rates. So this adds, if you want, even more to the puzzle of why that delay in raising rates. I have a few more seconds. So the last thing I wanted to talk about is talk a bit about the combination of vacancy and unemployment. So vacancy data, they are a bit the black sheep data of business cycles. People don't know very well. They don't know them very well. They don't know where they come from. They don't know what they mean. They don't trust them. But we think that combining unemployment and vacancy data is actually very powerful. So today I showed you how you can use for normative analysis, but they actually also have predictive power. So we have another paper in which we use the same unemployment and vacancy data to try to predict recessions. So what we do is basically we start from the SAM rule that I'm sure most of you know that I plotted here, which is just looking at when the unemployment rate goes up and is declaring that a recession has started when the unemployment rate basically increased above 0.5 percentage point. So this works well if you are starting from the 1960s. But you can do a SAM rule with vacancies, which is what I'm showing you here. And this works also pretty well. But the key thing to realize is that in the type of models we have in mind, when you have a recession, unemployment goes up and vacancies go down. So what you can do is you can require both of them to move. You can take the minimum of this indicator. And when you do that, you get something that's much less noisy, because if you describe a recession as wanting both higher unemployment and lower vacancy, you get a much cleaner signal of the recession. When you do that, you can lower your threshold to 0.3 percentage point. You get something that's much faster at detecting recessions. And if we apply to today, what you can see, so this is our indicator constructing with unemployment and vacancies, you can see that actually the US might have entered a recession as early as March of this year. And what's nice with this is, so not only you get an indicator that's faster than the SAM rule, it also works over the entire sample. So this is, you can actually detect the 15 recessions since the Great Depression, and you have no errors at all. There are no false positives. So you get, whereas the SAM rule actually breaks down before 1960. So by combining unemployment and vacancies, you can also get a really good indicator of recession. I'll stop here. Thank you.
Our first discussant is Hee-Ju Ahn.
So I thank the organizers for giving me this chance to discuss this important paper about the U-Star. I'm Hee-Ju Ahn from the Federal Reserve Board, so the usual disclaimer applies. So Pascal already did a great job in explaining the paper, so let me jump into the actual discussion. The paper provides a novel characterization of the U-Star, guided by a theory. And the beauty of their formula is that it's easy to implement, which is great news for a practitioner like me. So in my discussion, I'm going to first discuss the implication of the missing piece in theory. Okay? And then I'm going to try to explore the level and growth of the full employment directly, and then consider broad-based and inclusive theory. Okay, theory. So here I'm going to argue that a model with job separation margin, with a higher elasticity of unemployed workers, can still explain the observed in the rectangular hyperbolic beverage curve, but will lead us to higher U-Star. Okay, so here's my model. So unemployment model with unemployment inflows, the job separation margin. So here, my matching function has a standard Cobb-Douglas function. With elasticity parameter to the vacancy rate is 0.3, and the elasticity parameter for the unemployment rate is 0.7. Okay, so 0.3, the constant in the front, is a matching efficiency parameter. Okay, so if you divide both sides by U, then the job finding probability becomes a function of the market tightness V over U. Okay. And the unemployment rate standard in the literature is approximated with the job separation rate, over the sum of the separation and, job finding rate. Here, S is the separation rate. Okay, let's consider two cases. Okay, in period 1, the vacancy rate is 4%, and the job separation rate is 1.25%, and the job finding probability is 30%. So once we are given with the vacancy rate and the separation rate, we can solve for the other parameters. So in the first period, when the vacancy rate is 4% and the separation rate is 1.25%, unemployment rate is 4%. And suppose that there is a recession comes, the vacancy rate is 2%, okay? The vacancy rate is halved, and the separation rate is 1.75%, the job loss rises. Now our unemployment rate is 8%, okay? So vacancy rate is halved and unemployment rate doubled. So we still have, this still, rectangular hyperbolic average curve relationship. But now, our social planner has a different constraint that is, Cobb-Douglas matching function. So in this economy, the optimal market tightness is 3/7, less than 1, okay? Meaning that in this economy, less tightness and higher U star are optimal because, job seekers contribute more to a match than recruiters. The social planner wants, higher U star. So the takeaway, of this demonstration is that the counter-cyclical job separation is a feature of the business cycle, okay? So once we consider that, and also once we consider the higher elasticity parameter of the unemployed workers, which has the empirical ground, then we can still, explain, the observed rectangular, hyperbolic average curve, but we'll have a higher U star. Okay, now let me move on to the estimating, level and growth of the full employment, the E star. So if you are interested in, full employment, why don't we directly estimate it, okay? And then see whether, where we are in terms of the full employment, nowadays. So here, as a cyclical indicator, I'm going to focus on the employment to population ratio, which is one of the important, cyclical labor market indicators. And the merit of the employment to population ratio is that the measure is affected less by misclassification errors, relative to unemployment rate and the participation rate. And also, pay attention to the payroll gains, right? So we need some cyclical benchmark for it as well. So here I propose a new concept based on, FAIR formula that is the level of full employment, okay? FE means the full employment, and EP means the employment in population or employment in payrolls, okay? So here the definition of FEEP at time t is 1 minus FIRO multiplied by participation rate trend. Here participation rate trend is the non-cyclical component of the participation rate and multiplied by population, okay? Here the participation rate trend is from Hornstein and Goodlab. So if FEEP and FIRO disagree with each other, then the source is the participation rate cyclicality. And let's see how relevant that is in the assessment of the full employment. And turns out that it is. Panel A shows the unemployment rate and FIRO. Okay, unemployment rate is blue line and black line is FIRO. And panel B shows employment to population ratio and FEEP EPOP ratio, the black line. So red circles capture the period when both FEEP and FIRO say that we are at or above full employment. But green bar, green arrows, depict the period, when FEEP says that we are at full employment, but FIRO says that we are not there yet, okay? So it turns out that participation rate cyclicality is important in assessing the full employment, and according to FEEP, labor market tends to reach full employment in a mature expansion, okay? So the takeaway here is that FEEP indicates less slack than what FIRO suggests. Okay, so here's a new opportunity to all of us. So it turns out that the FEEP gains, the FEEP growth, the employment growth that is needed to maintain the full employment can serve as a nice benchmark for payroll when we assess the cyclical position of the economy. Okay, so here you are looking at the payroll gains, the blue line, and the black line is the FEEP gains, the benchmark. So here are empirical regularities that I uncovered. So in a mature expansion, payroll gains, seem to be very similar, to FEEP gains, okay? But when a recession comes, payroll gains, become slower than FEEP gains. Of course, we are interested in, recent period, right? So let's take a look at what happened to the pandemic period and the recent months. So the sample period here is from 2020 January through the August 2024. So panel A shows the EPOP ratio, the blue line, and the black line is FIB EPOP ratio, and the red line is FIRU implied EPOP ratio. So according to this measure, so the economy has reached the full employment in 2022. We discussed it yesterday, right? Okay. So it seems like, so looking at the 2023 and the recent months, so, the FIRU, labor force participation rate, and the FIB, the FIRU implied EPOP ratio and FIB EPOP ratio seem to diverge. So there's a little bit of uncertainty about, whether that reflects immigration or, the cyclical strength in the, labor force participation rate. So there's some uncertainty about it. But both the indicators, say that we are at full employment. So let's take a look at panel B that shows payroll gains and FIB gains and FIRU implied employment gains. So from 2023, actually the second half of the 2024, payroll gains, these two other benchmark gains, move in lockstep with each other and gradually moving towards zero, meaning that the economy is reaching to the full employment. Essentially, the gradient, is close to zero. Okay, so if you ask me, are we in a recession? I would say it's less likely. But if you ask me, is the recession is coming? Then I would say the risk is elevated. But the caveat is that we know that there is uncertainty and the measurement issues in the payroll employment these days. So I have 4 minutes. Now let me discuss the broad-based and explore actually broad-based and inclusive FIRU. So incorporating heterogeneity in the assessment of the full employment is a difficult job. So let me take first step based on my own research that I did with Bart and Aisha Shahin. So in our paper, we argued that the U.S. labor market is approximately the dual labor market structure supplemented with the tertiary segment representing home production. Okay, so primary segment is constituting the 55% of the civilian population, has the unemployment rate of 2% only, very low. Okay, the secondary market composing 14% of the population, has the unemployment rate of 26% on average. Okay, and this small segment, account for the 60% of the unemployment pool on average. The tertiary segment composing 31% of the population, and the people there are mostly out of the labor force. But when they enter the labor force, they experience an unemployment rate of 20%. Okay? So here I make an extreme assumption. That is that this nice FIRU formula can be applied to all three markets, and in all three markets see the same aggregate vacancy rate. I know that this assumption is extreme, so I'm going to revisit that. And let's see, what happened, what is the FIRU level in this, three labor market. So panel A shows the, primary unemployment rate, which is a dotted line, and the thick line is the primary FIRU, okay? The panel B shows the secondary and tertiary unemployment rate. The dotted lines are, secondary red and tertiary, blue unemployment rate, and the thick lines are FIRUs. So primary segment rarely experiences slack, but the other segments are always in slack, okay? So if you buy this analysis, then takeaway is that FIRU may not represent anyone's full employment experiences. If you don't buy this analysis, then it means that we need different models for the broad-based and inclusive FIRU. But let me give you another interesting example, racial disparities. So I took the data of the total unemployment rate, whites unemployment rate, and blacks unemployment rate, and take the logs and demeaned it. And then I plotted, and it turns out that they essentially match up with each other. That means that this FIRU formula can be applied to the whites unemployment rate and blacks unemployment rate, because it means that this rectangular hyperbolic average curve relationship applies to both racial groups. So I calculated FIRU for whites and black. So panel A shows white Americans, unemployment rate, the dotted line, and FIRU, the thick line. So white Americans experience full employment during most of the mature expansion. But black Americans, they never experienced full employment until 2019. So if we care about welfare, and that's the reason why we care about U-Star, then we should think about these disparities and welfare. Of course, let me confess a caveat to this analysis. So blacks' job separation rate is much higher than white job separation rate. So once we consider that margin into account, blacks, U-star can be higher than what you are seeing. So I tried to, find the aggregate implications. So I, I weighted, these aggregate measures using the population weights. And here you are looking at the dual labor market considered. The figure is the red line, and the blue is the aggregate figure. So meaning that once we consider macro heterogeneity into account, there can be less slack, and the U-star can be higher than what the baseline figure suggests. Okay, so let me wrap up. So in my discussion, I showed that once we consider the job separation margin with higher elasticity of unemployed workers and participation rate cyclicality and macro heterogeneity, there can be less slack than what the baseline figure suggests, or the figure can be higher. Okay, here I didn't have time for this, but once we consider the measurement errors in the CPS, in the current population survey, there can be more slack. Okay, so the data quality matters. So the risks are both sides, but perhaps more to the side of the less slack or higher, U-star. So going forward, let me just mention, two more things and wrap up. So as an econometrician by training, I would like to mention this. So this U-star or figure may be more precisely identified in a multivariate setup, and the estimate can be more efficient. And second, conceptually, figure, NIRU, and natural rates are, different. But empirically, they can share some, common dynamics, meaning that, theoretically, there can exist a set of conditions or a state under which these three stars, are aligning. And that can be important in thinking about the optimal monetary policy and policy evaluation. Thank you.
Our second discussant is Bart Hobein.
Well, thank you for inviting me to discuss this paper with a title that I also really like. It has something very Einstein-esque to it, so I think that's really wonderful. And so I guess this is a very simple policy prescription, and I think that's very attractive that it's simple. But I think it's also important to kind of discuss why it's so simple, and when we should take it seriously, and when maybe we should realize that there's some assumptions that we might question. So that's my task here. So let me just start with the three assumptions behind this theory, and because it's so simple, I'll do this kind of in an Econ 101 framework. So this is beverage space. Suppose we observe an unemployment rate of 8 and a vacancy rate of 2. That's just by example, or maybe if you believe Pascal's last slide, this will be 6 months from now, but I'm not that pessimistic. But then basically what this paper says is what the government should do is minimize the sum of the unemployment and vacancy rate. So it gives you this indifference curve. It's a linear indifference curve. And then there's a technology, which is the beverage curve, which they define as a hyperbolic curve. I'll discuss why this approximation might actually matter later on. And policy moves, we're always on the beverage curve, according to them, which is not always true according to most models, just for the record. But let's leave that as an assumption, because deviations from the beverage curve tend to be relatively short because of the adjustment dynamics in the labor market. So we're always on the beverage curve, and policies move us along the beverage curve by stimulating labor demand, I guess. The paper's not very specific on how you do that, but let's just assume that's how you do it. Then because this beverage curve has this particular hyperbolic shape, the optimal point, the pharaoh as they call it, is on the 45-degree line. And so there's three assumptions here that are important. Should we minimize U plus V? Is every policy, are our policies moving us along the beverage curve? Are they potentially moving the beverage curve? And then on top of that, there is this approximation to the beverage curve, a good approximation. So I'll cover all three of them, but the most important one is this. The bottom line of what I want to say is, this is not the only paper. There's several recent papers that I would say get hung up with a vacancy of unemployment rate of 1, and I'm very skeptical from a measurement point of view that is something that you want to use as an anchor. So let me kind of spend most of my time on that. So the main assumption that they argue is basically a marginal rate of transformation of 1 between unemployment and vacancies. And they quote there's a huge literature on the cost of hires. There's actually a whole field of economics that covers the cost of hires. I don't meet very many people who work on personnel economics, but I do give speeches to people who do human resource management, or I used to when I was at ASU. So let me cover a few things. First of all, the cost of a hire is actually the relative cost. It's not constant over time. I think Steve has a QGE paper with John and with Jason on this that shows that the vacancy yield is very, very cyclical. And so assuming that this vacancy yield is not cyclical, which is kind of implicit in the assumption in this paper, I find it a little dubious. And then on top of that, the literature on cost of a hire measures every hire. We don't distinguish whether we hire someone out of unemployment, or whether we hire them of non-participation, or whether we hire them job to job. Now that is very important because the cost of a hire is about $4,800 per hire. That's high. But the Society for Human Resource Management actually publishes the distribution among respondents of the cost of a hire. So the average is $4,800, but the 75th percentile is only $4,200, and the 25th percentile, which presumably is hiring Kamala Harris in a job in McDonald's, which seems to be a highly touted hire that we hear a lot about, that's probably not $4,800 cost because and there's many short tenure jobs for which if you spend $4,800 on hiring a person, that will be way bigger than the surplus of the job. So mixing those costs across different types of hires and aggregating them and then applying them to unemployment, I find a little hard to understand exactly what the cost of hiring out of unemployment is from that. And then there's unpriced benefits of vacancies mostly because, we don't really know whether the Great Resignation was a good thing or a bad thing. Maybe people moved to jobs that they're much better matches at, and that's why we're now seeing strong productivity growth. Maybe that was not the case, but the point is there might be other benefits there that are actually not necessarily included in the price. So that's on the kind of this marginal rate of transformation. The second thing that I just want to say is that I'm really skeptical about interpreting job openings literally as the level of unmet demand for the unemployed. And this gets done frequently, and I think that's just... Now, the time series that Pascal included also is mixed with centimeters of hiring at job advertisements that the Conference Board collected, for example. That clearly is not the level of unmet labor demand. That's a proxy. So I think that is important to say. And then let me show you why I think this is important. I plotted here something that I labeled differently than Pascal has it in his charts, but it's kind of the same point. So there's a discussion about demand and supply and the labor demand, and the demand coming more in balance with supply. And a lot of people make this plot, where they plot the labor force, and then as demand they have a proxy, which is employment for the CPS plus job openings. But job openings are, first of all, they're jobs. Secondly, they're also hires out of not only hires out of unemployment. And we, in this room, probably have never applied to a job opening that would be part of JOLTS, because that job opening you need to start working within 30 days, but most of us don't even apply to job openings like that. So what you're seeing is that it looks like there's always excess supply and a low demand, but that might just be because the job openings level is undermeasuring the level of unmet labor demand simply because of the way vacancies are defined in JOLTS. So I think that's the most important part. Now, there's a couple of other things. They give it a theoretical example of why you should take minimizing the sum of U and V seriously, and they introduce a version of the Mortis and Pissarides model. But in the particular example they give, the whole model is proportional in productivity, which means that unemployment and vacancies don't move when there's a productivity shock. So I'm sure there's other examples that you can give where that's not the case, but this particular example I find not particularly useful to understand why you would minimize the sum of U and V in this theoretical framework. Though I like this example because I tend to think of more optimal policy as moving in a kind of in a labor market framework, moving productivity or stimulating labor demand, and then you have two constraints: a Beveridge curve and a labor demand constraint, a labor demand equation. So it's almost like a principal agent problem. And then I think there's been a lot of discussion, what is the cost of doing this in terms of the inflationary costs? So I included that as phi. And there's been many papers recently about that. So you can think of this framework in an output inflation trade-off, but that's different from what's done in this paper. In the remaining time, let me talk about two short things. First of all, this paper assumes that policy keeps the beverage curve fixed. And that's probably true for monetary policy, although hard landings cause maybe a temporary increase in separations. But that's not true for many other policies. And that's actually important. This paper focuses on kind of the whole broad federal mandate, federal government mandate of maximizing employment. But I think rightfully so, in the framework, the long-term framework for the Fed, it's explicitly stated that maximum employment is a goal that varies because of many factors that are outside of the control of monetary policy. And those are things that move the beverage curve. So what's in this paper is really might be useful for monetary policy, but might not be so useful for other policies that actually affect the position of the beverage curve, like UI, but also like WIOA, which is probably the thing that the biggest act that is meant to improve labor market functioning. And then the final thing, Hiju covered this already, but I think it's worthwhile doing. If you put in, instead of the beverage curve is this hyperbola, if you put in the beverage curve actually as the functional form that most of us use, like the one that Figura and Waller used, that Hiju was also referring to, then the solution to the problem that they have, you're going to minimize U and V, U plus V, sorry, not necessarily that I think that's an objective you should have, but suppose you have that, but you don't face the beverage curve they have, but a different beverage curve, then that depends on the position and the shape of the beverage curve. The shape's given by the match elasticity. Close to a match elasticity of 0.5, the solution, the approximate solution with the approximate beverage curve they use, is actually close to the solution you'd get with the functional form I would use for the beverage curve. There's a 0.3 percentage point difference. Now, I learned yesterday from reading Charlie's paper that some people actually dissent on an FOMC decision when they disagree with Nehru estimates by 0.3 percentage point. So that might be more material than I realized before these meetings. But it is relatively small. But if you take an estimate like Figura-Waller, we're talking about the whole population of West Virginia difference in the unemployment rate. So this approximation is actually, it looks nice, A is U times V, but it is, when you actually solve the problem that the authors are solving, it's not an immaterial assumption that that's your approximation to the beverage curve. The beverage curve, the shape of the beverage curve really matters, just to kind of reiterate what Hiju said. So, to end my discussion, let me just say that I like the Einstein-esque title of this paper, but I don't think that this is the E is MC squared of economics. But I really think what I liked about this paper, and I've done a lot of work on the labor market, is it made me really think differently about how should we think about maximum employment. We at the Fed are very focused on the Nehru and think a lot about the interaction between employment and the inflation rate. But let's take inflation out of the picture for a moment. How would you think about a world where you weren't even concerned about inflation? How could you think about maximum employment in that context? And this paper is really trying to find a conceptual and normative framework to think about this, and I think there's a real value added to that, even though I don't necessarily agree with the policy description. And I do think that that is useful because at the end, the current framework defines maximum employment as a broad-based and inclusive goal that's not directly measurable. But for someone who works at the Fed who's asked to give answers about the labor market, that's not the clearest guidance about what's asked for me to look at. So in that sense, this paper helped me also give a little bit more direction in that sense. Thank you very much.
Okay, I want to mention that the second author of the paper, Emmanuel Saez, is with us online, and we also have other people listening online. And I'm actually going to start this time with a question from one of those people online, Bob Hall. All right, maybe Bob is not ready. I'll give him a minute and call on him again. Steve Davis.
This is cruel. This happened to me. Can everyone hear me?
We can hear you.
You can hear me?
Yes.
No. Yes, okay. All right. Well, this actually began as a comment that I formulated for the first session yesterday, but we didn't get to me, so I'm going to pursue it now, and it fits right in. And that is that the discussions of monetary policy almost always assume that the natural rate U star is a constant. And there's a huge amount of research that's reflected in this the session we're looking at now, in which U star is an endogenous variable of the system, and that's a big step forward. The amount of variability, though, in U star is relatively small compared to other estimates, including work that I've done with Mariana Kudliak, which I recommend and you can get from her website. Let me just mention one thing one problem that permeates the literature today, which is misunderstanding of what happened during COVID. During COVID, workers were counted as unemployed who had kept their jobs, but temporarily lost their work because they were put on temporary, and almost all of those workers were recalled. And so it's really important to separate these people are irrelevant to the matching process because they have not lost their matches. And Mariana and I have written a paper on that, which should be mandatory reading in this literature because it manages, it gets rid of that huge spike in which it looks like the DMP model is just not working. And the answer is that you're applying it to the wrong people. So every time you see a huge spike in somebody who's doing recent labor market dynamics, find out whether they correctly understand that the big spike was not job loss and search, but rather was people waiting for successfully to be recalled to their work, and it makes the DMP style understanding of what happened during COVID much slicker, and so I urge everybody in this growing profession to pay attention to this proper understanding of what happened during COVID and get rid of that big spike of misunderstood status of workers.
Steve?
Yeah, thank you to the authors for the interesting paper and the great discussions. I want to start by putting some numbers around what I think is an important point that Bart made, and that's whether we should interpret the JOLTS-based vacancy measures literally as a measure of unmet labor demand. And he suggested not, and I want to amplify that point. So in my 2013 QG paper with Faberman and Halterwinger, one of the things we do in that paper is construct an estimate for the fraction of hires that are not mediated through the JOLTS concept of vacancies. Bart has already made the point that by design, the JOLTS vacancy concept doesn't capture certain vacancies like the ones that are typically relevant for our jobs. So the number that we estimate is 14%, okay? So and I'll just repeat that. The JOLTS vacancy concept misses 14% of the vacancies that are nonetheless show up in the JOLTS hires concept, okay? In addition to that, there's a separate factor, an additive factor. The JOLTS sample doesn't capture the youngest employers for very practical reasons. It's very challenging to immediately identify from the university administrative sources the newest establishments and put them in to the JOLTS panel survey, okay? And it won't surprise you to know that new establishments and more generally very young establishments have a lot of hiring, and so they have a lot of vacancies relative to their share of employment. So if I had to guess, that I'd say that something like that the JOLTS vacancy numbers are something like 15 to 18% below what we might think of as the underlying vacancy rate concept that corresponds to the JOLTS data. Now, that's an average, and we did not look at this in the paper, but as Bart suggested, that number probably fluctuates cyclically as well, okay? Now, I want to relate this to one of Hee-Ju's points. She had a different way to approach whether the labor markets are slack or tight. Her basic conclusions there are in line with, if you just take the points I made about the understatement and refer to the pictures that Pascal showed, all of those vacancy series he's got are too low. They should shift them all up, okay? By different amounts at different points in time, that's less clear. So, or exactly how much is unclear. It's clear you should always shift it up. So that rather changes your interpretations about whether we're mostly in periods of slack or labor market tightness. So this is just a first order issue. And unless I missed it, there's no discussion of this in the paper. There's no discussion of the measurement of the V part. There's a discussion of the measurement of the U part, and Bob Hall just added some important observations about the U part as well. But if you're going to try to operationalize this formula, then there's really a bunch of first order measurement issues you need to address. Now, one more comment if I can. There were some nice discussions of the assumptions that went into the model and that led to the formula. I just want to stress one more, and that is, as I understand it, the simplicity of the formula, and it's nice to have a simple formula, rests on a very aggressive assumption about the value of time when you're unemployed, okay? And the baseline assumption in the analysis is that there's zero value to being unemployed, zero social value. There may be private value in the form of unemployment benefits, but zero social value. Now, I agree with Pascal that there are psychological costs of being unemployed. I take them seriously and so on. Nonetheless, this is a very aggressive assumption. So I want to refer to another paper that I have, which speaks directly to the value of time that people assign to unemployment. So I've got a paper coming out in the AER with Pavel Krolakowski, in which we survey a population that's directly relevant to this question. We are surveying people who are collecting unemployment insurance benefits. We survey them the day after they get their first benefit check. And we ask them a bunch of questions about their willingness to have continued working on the job they just lost at a wage cut. So 2/3 of the people in this survey say they would not be willing to accept a wage cut of 25%, okay, to have continued working on their own job. The unemployment replacement rate in this sample is about 38% on average. So that says that at least 2/3 of the people in our sample have a value of time net of unemployment benefits that is more than 35% of the wage they just lost, and maybe worth much more. Maybe it's 50, 60%. So I just find there's many other pieces of evidence out there in the literature, but this formula, though, that simple formula, rests on this very aggressive assumption about the value of time, and some discussion about the sensitivity of the results to that assumption would be helpful.
Bill English.
I was struck by the figures showing that the NAIRU measures are much higher than the FAIRU measures. And it reminded me a bit of Barrow and Gordon and the idea that the socially efficient amount of labor may be higher than the sustainable level of employment that you can have and not have an inflationary effect. There are wedges there that matter, taxes on labor income and imperfect competition, which leads to markups that put a wedge between the socially efficient amount of labor, which may be higher, and the amount that's actually attainable without generating inflation, which is likely to be a lower level of employment. I wondered if that's captured in the model or if this just is a kind of something that looks the same but isn't in fact intellectually the same. Thanks.
Christy?
I want to follow up with something that is very similar to what Bill said, but I'll put it in a stronger version, which is that a concept of full employment that isn't consistent with stable inflation, I don't understand that as a sensible goal for policy. And so there's this measure may be interesting to talk about, but if you're thinking about conducting monetary policy or fiscal policy or anything else that you're doing, something that just isn't consistent with stable prices or stable inflation just doesn't make a lot of sense. And it's actually related to something that the discussion of the broad-based and inclusive maximum employment goal. I think one of the things that we lose sight of is the marginal groups that get hired when the unemployment rate is very low are exactly the groups that lose their jobs first when inflation is high and the Fed has to tighten. And so trying to separate those two goals, I think, is just not possible and very dangerous.
Okay, let me go back online. John Halterwanger?
Great. Can you hear me?
Yes.
Good. So I think, I'll say an attractive feature of this approach is that it relies, at least in principle, on the DMP framework as a basis, and I think we all agree the DMP framework is sort of the core framework we should be using. Having said that, we've, I think, increasingly recognized we need to refine the DMP framework in some fundamental ways for it to match the data. And so what do I have in mind? We know the standard matching function that just specifies hires as a function of vacancies and unemployment does terribly in terms of matching two key outcomes, particularly the job filling rate and the job finding rate. The matching function does terribly on these. And so what we've been doing, many of us have been doing, I've done work with Steve Davis, a paper that was at Brookings a couple years ago with Catherine Abraham and Lee Riddell, partly based upon nice work that Bob Hall had done, is generalize the matching function to kind of recognize that, related to some of the discussants' comments, that not all vacancies are the same. Recruiting intensity varies across vacancies and across time, that hires come from more than just the unemployed, and search intensities vary quite dramatically across different groups within the unemployed and across different groups, including the employed and out of the labor force. And what we've discovered, by the way, you can say, well, the paper looked at this because it said, well, let's go consider broader measures of unemployment. We found that doesn't work very well, because all that does is just sort of, it counts all of those. Let's say if you go to U4 or U5, U6, it just counts all those equally, and that's just not sufficient. So if we're going to head in this direction, I think we need to try to think about, well, what would you do in this context if you used a generalized matching function instead of the traditional matching function? Last comment, I just want to echo Bart's point that the evidence is overwhelming that job-to-job flows are moving individuals up the productivity ladder. Do we know that worked especially well in the Great Resignation? Not yet, but historically, that's been the case. Thank you.
Carolyn?
I'm going to try to be brief because I think every comment I wanted to make has already been made nicely, so I'll try to be very brief. Bart made the point that the cost of servicing a vacancy assumption is quite aggressive in this paper, and it is very important for the formula. So that is one of the most important assumptions for the nifty formula to work. Steve Davis made the point that another important assumption for the nifty formula to work is that there's no social value to time while you're unemployed, because the psychological stress totally offsets all of the value of the leisure or time for home production. I think that's another very aggressive assumption, and Steve gave us some empirical evidence about why it's not very plausible. And then finally, I found Hiju's division of the labor market into primary, secondary, and tertiary to be very important. And it also underscores the importance of hiring from the out of the labor force pool, which is not trivial at all. So I think that's another important assumption that's built into the NIFTY formula. So I just, yeah, I'm just going to stop there.
Tara?
Thank you. So I'd like to make 2 points. So I want to two-hand Steve's point about having more discussion about the data issues around vacancies. In particular, one thing I'd like to highlight is if we want to use this for real-time policy making, we have to think about the data revisions process that's experienced in vacancies in a different way than what we're seeing with unemployment. And also, there was this really nice conference that was held here at Brookings back in January that talked specifically about the trend in vacancies over time, and that's an issue that might be driving some of this interpretation as well. The second point, somewhat related to that, is what are the challenges of taking the unemployment rate and the vacancy rate there together is that we have to think about composition in each one and the changes in those compositions over time. And so by bringing in vacancies as well, we're bringing in additional compositional challenges that are affecting the trends and probably will make it hard for us to actually target this in policy. Thank you.
Back online, Joe?
Thank you. I want to respond to Bill English's and Christy Romer's point, because I think it's a point that many macroeconomists would have. How useful is a measure of unemployment gap if it's always positive? Doesn't that just inconsistent with this, with macro model of inflation would be spiraling ever downward? And I think the answer, is really, and I'm surprised that Bart Hobein didn't mention this because he's done work on this as well as you, John Steinson. We know that if there's downward wage rigidity, it tends to bend the Phillips curve and give it a very flat segment. And then what you get is that the economy tends to operate above the natural rate of unemployment. Moreover, it's very difficult for central banks to estimate the natural rate of unemployment in that regime. And so there's overestimates of the natural rate and more reason that you're always above, with little downward pressure on inflation. That can go on for years and even decades, in my view, and I think we shouldn't just rule that out. I think that's actually an important feature. By the way, Rick Michigan raised the paper of McClay and Tenreiro that gave a reason for a flat Phillips curve based on optimal central bank behavior, where the central bank keeps unemployment near U-star. But that's a world in which there's just little information to estimate a Phillips curve, so you get a zero slope. In reality, the unemployment rate moves a lot. And so there's plenty of information, and it just is flat, has been flat for a long time. But that's just in a region, and we don't see the whole curve. Anyway, so I think I would caution people to not use this as a reason not to like the paper. I think actually the paper's results for the U.S., as improved a bit by Hiju, are still very plausible. Now, the final point is that Bart ended with a point about labor market institutions shifting the beverage curve. I think that's very important if you want to take this to other countries. I've looked at the results of this paper applied to other countries, and they don't work so well. And I think the reason really is other countries have had, especially in Europe, have had much bigger labor market institutional changes that need to be addressed if you want to use this framework outside the U.S. and even in the U.S. Would benefit, improve the results.
Neil?
This is just, I think, to reiterate Christina and Joe's point about it would just be interesting to understand what the Phillips curve looks like, what Phillips curve regressions look like with your measure of full employment, and does it perform any better, or do you need to also rely on kinked Phillips curves to explain the behavior of inflation?
Valerie?
I just wanted to follow up on several people who would question the assumption that there's no value to unemployment. since the 1970s, there's been evidence of pro-cyclical death rates, and now we have more recent evidence from Christopher Room, numerous others. And in fact, Karen Dine and I were discussing yesterday this from a time, use, and care of family members concept, whether it's elderly family members or young children. There's just evidence that when you're working hard, other things fall by the wayside. So I think there is some value to unemployment, particularly for people who have dependents.
Oleg?
I wanted to return to Bart's last comment, and actually this is what Christina talked about. It's kind of very impressive that you can figure out the optimal unemployment level without any knowledge of the rest of the economy, like what are the shocks, what are the frictions in the background, right? And it kind of makes, like, there is the premise that we're talking about monetary policy as the tool to deal with this, but this is only true if the underlying frictions are sticky prices or sticky wages. If you think that unemployment was generated for other reasons, like there were a lot of jobs created in a part of the economy that actually did not live up to productivity expectations, or there is some financial shocks and vacancies cannot be created because of the financial constraints and stuff like that. Optimal monetary policy it can accommodate it, but it probably cannot resolve that problem at all. And so the knowledge of the U star might be useful, but you really need to know the sort of the frictions and the shocks in the background to sort of know how to respond to that.
Okay, so I'm going to send it back to the authors.
All right. Well, that's a lot of stuff. Let me just address a few things. So first of all, so we derived this formula to have something simple because we thought that would be appealing to policymakers. But in the background, we have actually a paper that we wrote first that has a more complicated formula. And that formula, at the time when we wrote it, I guess nobody cared about it, but maybe now people will be interested to look at it. So it's going to address a lot of the things that we mentioned today. So the formula allows for a beverage curve that's not an hyperbola. You can just estimate the elasticity of the beverage curve, and the formula is going to take that into account. So that addresses what Bart says, that indeed, we don't know exactly what is the shape of the beverage curve. In fact, the beverage curve does change its shape over time, so the formula would allow for that. The formula allows for a value, a social value of unemployment that's not zero, of course, so you can make it high, Zero, we think, is, it's something that's not completely unrealistic, but we don't know exactly what that value is, so you can plug it other value, you can make unemployment more valuable, and then you can see, okay, how does our fair rule respond to that? You can also, then going back to vacancies, you can change the cost of a vacancy, you can put that cost in a formula and see what happens. And then in that previous paper, what we also do is then do a comprehensive analysis of the sensitivity of the fair rule to all these parameters. But something I want to point out is that, so of course, if parameters, the cost of unemployment, the cost of recruiting, the shape of the beverage curve change, the fair rule is going to change. But the bottom line is that for the range of things that we found in the literature and we thought was realistic, the fair rule does not respond very much. So what I'm talking about is roughly 1 percentage point up, 1 percentage point down compared to a baseline if you cover the range of parameter values that you find in the literature. So it's not zero, and maybe tens of percentage point matter, but it's also not a vast amount compared to the fluctuations in unemployment themselves. So that's one thing. On the moving the beverage curve with policy, that's something that Bart mentioned as well. So of course, if you think about unemployment insurance, that's going to move your beverage curve. You can't use this framework just as it is. You need a more complicated analysis. And there again, we've done work on that with Emmanuel and Camille, and then we have papers showing how that U star or theta star, in fact, is going to change if you have unemployment insurance. And it's more complicated, but the same framework can be used to think about these issues. So we don't have to use it only to think about monetary and fiscal policy. Or something that I wanted to clarify that I think was probably not clear in the paper. So we don't think of vacancies as unmet labor. Absolutely not. And so in particular, that's not what we say, U has to be equal to V. So the old idea in Beveridge's book from 1944, he said, I think full employment is U is equal to V. What he had in mind is that V is unmet labor. And so, if you have people looking for a job, if we have the same number of unmet labor, that should be full employment. But that's not what we do here at all. Vacancies here are just a way for us to measure the amount of labor devoted to recruiting in the economy. Now, ideally, what we would want is a BLS to go out and ask firms how much man hours they devote to recruiting every month. If we had that information, we wouldn't need vacancies at all. We would have the number of recruiters, we would have the number of unemployed, we would use that for the analysis. Now, unfortunately, we don't have that information. The only proxy we have for recruiters are vacancies. And it turns out that roughly 1 vacancy is equal to 1 recruiter. But again, we don't think of vacancies as unmet labor at all. Vacancies are just a vehicle for firms to go and recruit people to come into their firms. Let's see, what else do I have? Oh, yes. Christie's point was interesting. I mean, I could flip it around. I could say it doesn't make sense to think about stable prices without thinking about full employment. You know, like your remark had really reflect, I think, the bias that the Fed has had to focus too much on stable prices and put the full employment mandate as kind of a secondary mandate. I mean, in the law, they should be both equally important. And we have measures to figure out what gives you stable prices. That's the NERU, although it's hard to measure. Here we're just saying, well, to satisfy the other mandate, we need another measure. That's the FERU. If these two coincide, well, then that's easy. That's a divine coincidence. The Fed can actually satisfy both mandates. But it's possible, you know, in models, there is no guarantee that these two things are going to coincide. It's possible that the NERU and the FERU are not the same. And what I showed you is that they might not be the same. Now, in that case, the Fed faces a trade-off. How much weight do you want to put on deviating from full employment? How much weight do you want to put on deviating from stable prices or, you know, your inflation target? And then, you know, that's the job of the Fed to solve that trade-off and decide where they want to be in between. But in models, there is really, in modern models, there is no guarantee that these two things have to be the same. They can be, but there is no guarantee that they are. And so, even though we don't have inflation here, it doesn't mean that, you know, the analysis is meaningless in some ways. And the last thing, maybe I'll finish with Oleg's point. Yeah, so that's the beauty of sufficient statistics. So sufficient statistics are usually used in public finance to try to think about optimal policies without putting too much structure on the economy. So here we're bringing that to macro, and our analysis is going to work in actually many models, irrespective of the shocks and various other things, as long as they have a beverage curve. Of course, that's not all models. And as you say, of course, as long as so here to apply to the Fed, it's as long as the central bank doesn't create other, you know, distortions. So here we're thinking about really a basic model in which it's nominal rigidities in prices or wages that create business cycle. Now, in a world like this, if you have a beverage curve, nominal rigidities creating a cycle, this is going to apply whatever the detail of the model. If you have more complicated setup with financial crisis and stuff, yeah, it's going to be more complicated and you'll have to deviate from that.
Emmanuel, do you want to add something?
Yes, let me add a few words. First, I want to thank Pascal, you know, for the presentation, the discussions, and everybody who commented. This is very, very useful and will allow us, you know, to recalibrate the presentation. On substance, I want to talk very briefly about the points that were raised on prices, you know, inflation. Maybe I'm naive, you know, I'm not really a macroeconomist, but for, you know, since 1990 to 2020, prices were stable. Yet, you know, we would see, you know, lots of fluctuations in unemployment. So in some ways, you know, we could say that the price stability was solved, but yet there was the problem of what is the correct you know. So in those so-called, you know, normal times, you would need really a definition of what is the efficient unemployment rate. And it's really in extreme cases, you know, that perhaps, you know, we had an economy that was way too tight, that it triggered inflation. And that's when, you know, price stability is going to come in. But, you know, we expect that a well-functioning macroeconomy has solved, you know, the price stability problem, but yet recession still happened, you know, and you need something to guide you towards what is an efficient level of unemployment. Thank you.
Great. Let's break and reconvene at 11:30.
Are you all set for your revision?
No.
Okay, let's get seated and get things off the road. Or on the road, I guess it is.
I know, a little bit.
Okay, so our last paper is going to be on the economics of sanctions from theory into practice. And Oleg is going to start. I think they're going to do a tag team.
Thanks for having our paper on the program. So it's 10 years since the war in Ukraine started, and it's almost 3 years since the full-scale invasion. Sanctions started 10 years ago, and unprecedented sanctions started 2.5 years ago, right after the full-scale invasion. So we collected quite a lot of data on what was happening with sanctions, what was happening with the Russian economy, and the interest of the topic kind of exploded. It sort of, one can say it almost geoeconomics, not just in the context of Russia, but in the context of other geopolitical conflicts, how much the sanctions and other economic tools can be used. And so what we wanted to do in this paper is both survey what actually has happened, what sanctions were used, what are likely effects of sanctions, but also kind of connected to the theoretical literature on optimal sanctions design and what we can say at the intersection of these two topics. So in the popular discussion, people really like to put things into two categories. Do sanctions work or do sanctions not work? And they want really an answer like yes or no. And clearly that's sort of the wrong way to ask that question. Sanctions is a tool. They can do what they can do. We should be able to estimate in the data the elasticities and so on. And then what we want to suggest is that you approach this question not with sort of a premise that this is a tool that works or a tool that not works, but it's sort of a tool that you can use optimally. You take some, optimality condition in the background, and it's highly unlikely that that optimality condition will tell you not to do anything at all, right? Typically, it would tell you what's the right mix of sanctions to use with different dynamic considerations, reputational consideration, if you want to put them into the model. But in any case, most likely the answer would be that there is an optimal use and mix of sanctions, and sort of we want to make progress on this and sort of promote this technocratic approach where there is no kind of premise, So obviously, the efficiency with which you can use sanctions, it depends on the size of the target country. If the target country is small, it's much easier to use sanctions. If it's large, there are all sorts of complexity related to it, and the integration of the target country into the world economy. Equally important is sort of the size of the sanctioning coalition and the unity within the sanctioning coalition. And if there is no full sanctioning coalition, then the enforcement of third countries that must be brought in alignment with the sanctioning coalition, and that's sort of equally important. And finally, something that when the country under sanctions is large, right, what you cannot overlook is the fact that there is a significant cost to sender, that it's actually costly to impose sanctions. You're committing to a costly action, and if you really want to use it, you have to accommodate the cost. So a lot of this is, I think, quite well understood and acknowledged, and a lot of the policy design relied on this logic, but of course the mistakes were made in the policy, and sort of it's interesting to see what in retrospect looks like sort of obvious mistakes or blunders of the policy. So if you look at the very broad data, you might make a case that sanctions didn't work. So those two last bars in the first chart is Russian growth rate in the first year of the war and in the second year of the war. It looks like it was a very mild recession in the first year and a fairly fast growth in the second year of the war. And that's against of a background of economic stagnation over previous 10 years, right? But then if you compare Russia to oil exporting countries, and that's the relevant comparison, while a lot of oil exporting countries enjoyed very fast growth in 22, Russia actually declined, and so the gap is pretty large between them. And so you can make the case sort of both ways, whether sanctions worked or not. If you zoom in more specifically on how the way sanctions were supposed to work, right? They were supposed to target the trade balance of the country. What you see immediately is that Russia actually enjoyed the record high trade surplus in 22, the year of the sanctions, right? And so that sort of immediately raises the question of like, what happened? How come, you have the unprecedented sanctions and yet you have the highest trade surplus on record? And then it becomes immediately clear because the sanctions targeted imports. It turned out to be politically more feasible to target imports first, imports of Russia, so export controls. And the orange line there, or yellow line, you see immediately that at the beginning of the war, there was a collapse in Russian imports. But nothing like that happened to exports. Exports were actually at record high for another year after the beginning of the war, and that created that trade surplus, and sort of the effects on exports only kicked in sort of much later on. So there is a very large literature that we try to survey in the paper, but we definitely don't do full justice to it. And here I'm just going to go to some of the main points that we have. So when you think about the goals of sanctions, right? So one goal is to limit production capacity, or in particular production capacity in certain sectors, right? And so that could be the goal of like really sort of crippling the military production or something like that. Alternatively, there could be a financial goal of actually like affecting the financial and the payment system. And so in the short run, you really want to affect the liquidity of the country. So kind of trigger a liquidity crisis, a financing crisis, a balance of payment crisis. That's kind of like a quick goal of sanctions. There could be a longer-term goal of putting strain on the budget constraint of a country, right? And sort of depending on which tools you have and which cost you're willing to accept, you can choose to go one of those three different routes, right? Affecting production in certain sectors, quick crisis, or like slow pressure on the balance of on the budget constraints. There could be additional considerations, and like if you're willing to go for sort of cheap options, you can sort of signal your willingness to do sanctions going forward, and that's like a very cheap thing because you don't really have to do anything now. And a lot of what's been done before the full-scale invasion looked like that, but that gives a heads-up warning of what's to come and sort of gives time for the country to prepare. And here you have to have the dynamic consideration in mind. There is another important one, is like obviously the best case scenario if you can keep all of these conflicts off equilibrium by committing to overwhelming sanctions. But once once that's not credible, once you don't have commitment to those overwhelming sanctions, these become on equilibrium actions as they have become now, then you really have to start thinking about the balance of costs and benefits. So in terms of trade, I mean, we have very clear analytical frameworks for thinking about trade sanctions. I don't know if Kostas is here, but like one of the central results, is due to Kostas and his co-authors, is that when we're thinking about the impact of sanctions that they have, you kind of have two things that come into the formula. One is the import to expenditure share of the country, and if you can affect deeply the imports relative to the size of the expenditure of the country, you impact the country a lot. But that also, what's interesting here is you don't care about exports at all from that perspective. And in fact, import and export sanctions are sort of equivalent in a way. Whichever one you use to affect the import side relative to the expenditure is kind of doing the trick. But that's this very long-run trade perspective when you're sort of in steady state. Once you're not in steady state, there is no equivalence like that anymore, and that has to be taken into account. And the second thing is, the other side of this is if you trade a lot with the country and if you affect its imports, well, there is a cost to sender, which is proportional to the relative size of the countries. And that's right there in the formula. And the second thing is the ability to substitute, right? If it's easy to substitute either towards domestic production or to other countries, then even if sanctions are massive, this ability to substitute offsets their role. And sort of what we see in a much more integrated world where third countries account for much bigger share of GDP and trade now, including China, India, Turkey, Brazil, it's much harder without building a full coalition and doing the enforcement. There are a few results on optimal sanctions, and so optimal sanctions are like terms of trade manipulation, and so you sort of do it like terms of trade. And if there is an additional externality in certain sectors, it's like a Pigouvian tax, and there are beautiful formulas derived in recent literature exactly how to think about that. I'm running out of time, and I want to pass it to Elena. So what's very important, what's been sort of probably emphasized, is the role of payment system sanctions. And in our basic macro and trade models, there is just no much room for payment systems, right? If you have, it doesn't really matter which currency you have. If you have spot currency, you can use the spot currency to pay for spot trade if you don't need to borrow or lend in the financial markets. Well, in the data, it turns out it's not the case. Payment system plays a huge role. They're much easier to enforce. And they actually seem to have much more important effects than many of the trade and financial sanctions that were put in place. And so what we do in the paper, we sort of discuss the different costs associated with use of different sanctions and sort of the effect that you can expect from them. So let me actually stop here and pass it on to Elena.
Thank you so much, and I look forward also to the discussant's comments. So with that theory in mind, let's think about what happened. And we have some people here who made it happen, so I'll be very conscious of that. So if you think about 2014 sanctions, they were focused on deterrence, right? One could say that maybe Putin would have moved in further than Crimea and would have acknowledged, actually, remember in 2014, Putin was still saying it's not him or the army, it is the little green man that nobody knows where they came from. So maybe because of the sanctions, the actual full-scale invasion was postponed. So that maybe that factor of deterrence worked. So there was deterrence. Also at the time, as Oleg has explained, you had the cost to send that was minimal because Russia's impact on global financial markets was almost irrelevant, right? But to Russia, which was borrowing at the time, the outstanding stock of gross external debt was 700 billion. Because of the sectoral sanctions, they repaid $250 billion just over a course of a year. So this is about deterrence, financial sector sanctions, and then some other sort of no-nonsense sanctions, much smaller. So then when 2022 came, one could say this was about imposing the cost. You promised the cost, I'm going to impose the cost. So you need to go, as we explained in the paper on the theory, you need to go full scale and be strong. It is also then about undermining Russia's ability to continue. So financial sector sanctions, export controls, and the limits on Russia's export. So the financial sector sanctions, yes, there was an impact. This is the liquidity of the banking system. You know how much the banks borrow from the central bank. There is a big drop. You see the pressure. You see bank runs. But on the exchange rates, you do see immediate sharp depreciation. But as the theoretical model suggests, you actually see an appreciation going in. Because what? Exports continue unabated, and if anything, very strong. And then you have a blanket sort of limit on imports. Why? Because many companies stepped back because they were unsure about their compliance regime. So they just stopped trading with Russia for a few months. So then, in terms of the limits on Russia's exports, Russia's imports, right? There was an attempt to block Russia's imports of critical goods, critical components, or maybe this sort of choke points, right? That again, you could have in the model. So did we attempt that? Yes, we did attempt that. And maybe in the early days, together with the general step back, you see a big contraction in the imports of so-called battlefield goods. But as the trade gets diverted or rerouted, basically the substitution effect on trade that you see in the model, other countries step in, most notably China, but also Central Asian, and there are some people here sort of writing about it as well. We see that's what happens. Basically, there is a rerouting, and Russia goes back to importing even the battlefield, the critical battlefield goods. If you look at Russia's oil exports, again, we saw it as the overall numbers on the balance of payments, but you also see here in terms of volume and price. The volume of Russian exports continued. And we see that, there's no reduction in volume of Russian exports. This is the bar chart. What we see is, again, rerouting. It goes to India, it goes to China. China picked up marginally, but mostly India picks up the biggest slack from Europe to India. We see the opening of the discount, so the Russian discount relative to Brent. You see the opening originally, and then as Russia finds alternative routes, Russia finds alternative fleet, the shadow fleet, and we see that, that discount reduces, and again, Russia continues to export as before. So then, actually, I'm even ahead of time. I can speak slower. So I don't have to be on a 1.5 speed. So I think the conclusions here are very important. And what I like about our paper is that we put the theory and practice together, because there is a lot of discussions about sanctions, about being a silver bullet, that's going to kill vampires, change regimes, and let's just go ahead. No, it is a practical technocratic tool that needs to have a measurable target. Of course, for a government official, if you don't have a target, you can never miss it. So in a way, it's wonderful. But for us policy analysts, it's not so wonderful. We want to have a measurable target like any other tool. If somebody says, well, in Greece, they're not collecting VAT, consumption tax are nonsense, right? We're not going to say that. We're going to try to think why consumption tax versus something else. What is the administration? So in the similar way, we need to unpack the sanctions through the modeling. What are the policy flaws in the design of Russian sanctions at the time? And what are the enforcement issues? So in terms of the policy design, I think for immediate impact, it would have been much more impactful to have financial and payment sanctions together with controls on Russian exports. To have this very strong message in terms of imposing cost, throw everything that we got, and also to have the practical effects according to the theory. Unfortunately, in a way, we ended up with the opposite. We didn't do anything with the exports. Eventually, the system adapted to the financial sector sanctions, and even for a short period of time, we actually reduced all the imports, which gave them extra cash. So although we arrested their reserves, which was not very costly to us, Russia accumulated potentially a shadow of reserves of another 220 billion. So we arrested 300, they accumulated 220 in a year. They said, thank you very much. So I think there were some lost opportunities that happened in the design of the 2022 sanctions. There is also very important, as we know now, the so-called West, compared to the Cold War times, no longer controls 70% of the global economy. It is less than 60. So if you have the non-aligned country or the fence-sitting countries, helping out Russia to reroute, you're going to have much more muted effects. Then, of course, enforcement also matters from our side. Do we have enough sort of a well-structured enough institutions to be able to enforce sanctions? We have institutions like OFAC and Treasury to do financial sector sanctions, and we've done whale hunting for a while. We don't have the same in the export controls area, and I do recommend the testimony by the top chip-producing companies, Texas Instruments, Analog Devices, Intel, that recently went to Congress, that you should watch that together with the movie Thank You for Smoking, and you will see a lot about our ability to enforce export controls. So, going forward, what have we learned? That we designed in 2022 suboptimal sanctions because of the political constraints. At the same time, there was some effect. Russian revenues would have been even high had we done nothing. And at the same time, there's been some reduction in the imports of the battlefield goods. And we're also learning important lessons and sending a signal to other potential malign actors. What might our reaction be? Thank you very much.
Our first discussant is Robin Brooks.
Just use this. Oh. All right. So thanks to the organizers for including me. I want to pay, before I get started, a big compliment to Alina and Oleg. We're all human beings. This war is just awful. And in the time since the invasion, they have done an incredible amount of work that transcends good research and is really public service. They have done all kinds of data exposition. So I am certainly someone who's deeply grateful. I am also in the camp that I believe that sanctions do work. They are a very necessary toolkit that we have to develop and get better at. And so I strongly disagree with people who say, yeah, Russia shows sanctions don't work. And we kind of throw our hands up in the air. So I'm going to make a couple points, and then I'll try and tie it back with Oleg and Alina's paper. Financial sanctions. In the days after the invasion, financial sanctions were like our go-to. It's the first thing we did. And we, the United States and the West more broadly, we have kind of infatuation with financial sanctions. We have this big banking system. We have a dollar-centric world. We're fixated on this stuff, and it is a distraction, I think. Obviously, just my opinion. There is an example where financial sanctions worked well. Turkey in 2018 under Trump was subject to sanctions that I consider financial sanctions, and Turkey immediately suffered a very big depreciation. It suffered a very severe credit crunch and a very deep recession. So that's exactly the kind of thing that we want financial sanctions to do. Turkey is a current account deficit country. It is a borrower on global financial markets. If we do something to mess with access to that borrowing, it will have a severe impact. Russia is a current account surplus country. It's totally different. It's a net lender to the world. It lends, okay? So what did we do? We sanctioned some Russian banks, most importantly, the central bank. And the chart shows you in black the current account surplus for Russia. And then the reserve accumulation or the foreign asset accumulation, in red I'm showing the reserve accumulation of the central bank, and then in blue everything else, okay? And by sanctioning the central bank, we prevented the central bank from accumulating foreign assets, but that foreign asset accumulation, it just shifted to non-sanctioned banks. So in a way, we just sort of picked winners and losers in the Russian financial, in the banking system. We didn't actually impair Putin's access to dollars and to euros. There's a simple solution to this, which is to sanction all banks. But of course, that is equivalent to a full trade embargo, because if you can't pay Putin through his banks, he's not going to sell you any energy. And it shows you what is really needed for a current account surplus country. You have to go after the exports, the trade side. And so we have Ben in the room, who was instrumental in developing the G7 price cap. The price cap really was recognition of this. This is sort of the intellectual evolution in the months after the invasion, okay? And of course, you can think of the price cap on a spectrum. If the cap is set at 0, it's a full trade embargo. If it's set at spot Urals oil price, then it does nothing, right? And so somewhere in there. And so I'm going to argue that really, we had the right tool, we just screwed up the implementation totally. And so we need to be very careful when we say, oh, sanctions don't work. On the theory part of the paper, I think there are two questions that we as economists need to help policymakers with. The chart shows industrial production in Germany. In the weeks after the invasion, there was basically a massive debate in Germany. How hard should we counter Russia? And there was a big debate on, should we do a full energy embargo? And Olaf Scholz, the chancellor, and his cabinet decided, we don't want to do that. We're going to go softly because we want to stabilize output. We're worried about the spillback from sanctions. Well, this is the result. You have huge stagnation in Germany, and the long-term cost is becoming clear of that decision. And so one thing that I think the literature and we need to do is to help policymakers work with this intertemporal trade-off. How hard do you hit? If you don't hit hard right away, then there will be costs to that, both in terms of the signal that you send, you're weak, and in terms of medium-term growth. The sort of the holy grail here is, of course, the counterfactual. What would have happened to Russia had we done this right? Could we have pushed Russia into a deep financial crisis? Could we have economically produced regime change in Russia and shortened the war? I think that is a model that we have the capability to construct. It's basically a commodity price shock. We know how to do that. We know how to model the exchange rate and so forth. So I think on the theory side, that's what's needed. This is probably the most important slide in my presentation. I'm now going to talk about what actually happened, in my opinion. This is just my perspective. Unlike Ben, I wasn't on the inside, so I'm going to tell you my outside perception. And Alina and Oleg do a great job talking about enforcement. So enforcement is basically, sanctions are rules. We are changing the rules. Here are the new rules. And enforcement is then an ex post. Are people doing what we told them to do? And if you have an enforcement problem, they're not doing what you told them to do. There's something much more insidious, in my opinion, which was ex ante undermining of the sanctions. So this is about design. And this is something that the paper doesn't touch on, but I think it really messed with the G7 cap, which I think is the right tool. I'm going to give two examples. So the left chart shows you the Brent global oil price, it's a global benchmark, and the Urals oil price. You can see this wedge open up between the two right after the invasion. I have two lines, February 2022, which is the invasion date, and then December 2022, which is the start of the cap. And in this interregnum, in this period between the war outbreak, the invasion, and the implementation of the cap, in Europe, there was massive lobbying on what the level of the cap should be. Remember, if the cap is low, that can really hurt Russia, right? Because it impacts export revenues and the amount of cash that Russia gets. And so on one hand, you had Poland and the Baltics who were lobbying for a very low cap, be very aggressive. And on the other hand, you had Greece, Malta, and Cyprus who were lobbying for a very high cap. They have a lot of shipping industry, and so they didn't want to mess with all of that. Okay? And I would basically characterize that tug of war as having been won by the shipping industry. We ended up with a cap of 60. Euro's oil price was a little bit above that, but we didn't like shock markets we didn't do shock and awe on the cap. The second thing that happened, and again, this is behind the scenes lobbying, this is ex ante undermining, is you would think the cap and its emphasis on Western service providers, you would think we would have banned the sale of Western oil tankers to Russia and its interests. So this is the shadow fleet that Alina mentioned. We did not. Every day, Western-owned oil tankers are still being sold to the shadow fleet, all the time. Ben and I, we have a live data set that we're updating all the time. This is ongoing. So if you look at total oil export volumes from Russia, on the right side, this is broken down by ownership of the oil tanker. Total volumes of exports are about the same, but the Greeks sold a lot of their oil tankers to the shadow fleet. That's the gray bars. Okay? This totally undermined the oil price cap. In operational terms, it gave Putin shipping capacity to basically run his own operation. And this is ex ante. This was the design stage. And when we are thinking about efficacy of sanctions, I think this is really what undermined things. This is not to dismiss the enforcement, the ex post side of things. German exports to Kyrgyzstan, as you all know, Kyrgyzstan, not the most obvious logistics hub for transport. German exports of cars are up 5,000% to Kyrgyzstan. This is just invoicing, right? Nothing actually ever goes to Kyrgyzstan. It goes straight to Moscow. If you total up exports to Central Asia of German cars plus exports to Turkey, there's a full offset. No oligarch in Moscow is wanting for a G-Wagon. They're all getting their G-Wagons. China, huge issue, right? Massive increase in exports. I see this as validation of the G7 price cap. If Russia gets money through exports of energy, it will find ways to spend that money. And trade is so dispersed, trade in goods, that it's very difficult to police. And so oil tankers are not dispersed. It's highly concentrated. We need to get our act together. What happened is not a failure of sanctions. It is a failure of implementation. Okay, so Ben and I have been publishing blogs furiously on one aspect of the oil tanker fleet, Sovcomflot. This is the sort of the state fleet. It's not the shadow fleet, really. 120 ships. Only 20 of these are sanctioned. The EU put a ban on seaborne oil going directly from Russia to the EU. So it used to be the case that oil tankers would shuttle between St. Petersburg and Rotterdam. You know, then you go back to St. Petersburg, you have a party, you service the machines in the engine room. It's all good, but now you've got to go all the way around Europe. You've got to go through the Suez Canal. Then you go to India. Super long trips, stuff breaks. And so what we've been tracking in our most recent blog is the movements of oil tankers getting super erratic. It looks like stuff is breaking. So there are pressure points. We can sanction more oil tankers and hurt Russia that way. So I think this is kind of two papers, and I think this is a bit in the literature attention. You can write a paper about Russia and how it's doing. I don't think that tells you anything about sanctions. The paper that needs to be written is a paper about us, about the West, and the political economy of sanctions and the vested interests that are interested in globalization, that like making money off of transport of Russian oil, and that opposed sanctions because it's going to impact their money making. There's a special twist to that, which is EU decision making. The EU in this whole thing has been extremely dysfunctional. Think about Greece, right? Greece has a veto in Brussels that it can threaten behind closed doors. And so it did. And so it ended up with a cap that's relatively high. It's like giving Rhode Island a veto over where we move our U.S. aircraft carriers. It's just not a good idea. Lastly, and this is kind of a plea, someone made a plea yesterday, the sanctions don't work narrative, I think it's dangerous. We have potential more geopolitical tensions that might arise, China, you name it. There are huge vested interests that oppose sanctions, Russia, China, OPEC, lots of commodity trading firms here in the West. So I think we just need to be very careful and not fall into that trap and propagate the story that sanctions don't work. Thank you.
Our second discussant is Rory McFarquhar.
So first of all, thank you very much for the invitation to be here and to comment on a paper which I thought was excellent and a really important contribution to the literature. I just wanted to engage with what I feel the main contributions are, talk about the theory section, and then the big questions that Robin was addressing of do sanctions work and so on. So first of all, obviously, bringing trade theory to bear on the sanctions literature, I think that there are a couple of very straightforward intuitions that come out of that. First of all, gains to trade are on both sides, and so symmetrically losses from sanctions are also on both sides, and so that has a number of implications. I thought that the empirical section was very important, although a question that has to be raised on the empirics when we look at the impact on GDP, on the current account, and so on is this really the metric? Sanctions are a foreign policy instrument. They're meant to achieve foreign policy goals. So the metric is, are you achieving foreign policy goals, not are you achieving X minus X% on GDP or causing a currency crisis or whatever. And finally, I want to have a brief engagement, obviously, on the big picture question of what this means for the policy of sanctions. So I'm coming at this as a practitioner, and not having had the benefit of this paper when we were designing the 2014-2015 sanctions, we nonetheless thought things through, and it was quite gratifying to see that there was a mapping of our intuitions with the implications of the theoretical literature. So first of all, as I was saying, the cost to sender concept, which plays out in politics, it plays out in, to some extent corporate lobbying, but also high politics, and I think that that's going to be very critical in our discussion of the current set of sanctions. And then there's this concept of backfill. So the idea that if you deny the ability of Russia to buy commodity X from the United States, but they can very readily source X from China or from UAE or from Kyrgyzstan, that obviously you've achieved absolutely nothing except for damaging your own companies. And so, that also loomed large in the minds of sanctions designers. And sure enough, that, corresponds to this question of elasticity of substitution when it comes to the sanctioned goods. If they're very readily obtainable from other sources, if they're readily substitutable for other commodities, then there's very little point in sanctioning those items. Conversely, there's the concept of choke points. So let's say the only place that they can get a specific chip or a specific part of the oil production chain is from the United States or from the United States plus the sanctioning coalition, then that's an ideal thing to deny Russia access to, because that is going to create the most impact. And finally, this issue of how big the sanctioning coalition is, the relative size of the sanctioning coalition versus the target. And I just wanted to, schematically think about that. So you can imagine at a spectrum where on the one side you have all of the world ganging up on a tiny little country, North Korea. The impact of sanctioning that tiny country on that tiny country is huge, and the impact on the sanctioning coalition is minimal. So that's one end of the spectrum. Other end of the spectrum, which is more or less what happened when Russia tried to sanction us back after 2014, when it was doing retaliatory sanctions. It was essentially punishing itself. It was denying itself access to foreign goods. And so that's just the road to being autarkic. If you as a small target are sanctioning a very large sanctioning coalition. But then there's this interesting point in the middle, which I label decoupling for obvious reasons, because naturally the conversation around Russia is really a bigger conversation about China. And what we're really talking about is the fact that sanctioning China is a very, very different proposition from sanctioning a small country, because you have to think that the costs on the one hand to the target and on the other hand to the sender are going to be much more in balance. That it's not going to be in any way costless. It's not going to resemble sanctioning Cuba, North Korea, Iran to sanction China. It's there you're much more talking about separating the world into different camps rather than the traditional concept that you're isolating a small country. On the financial sanctions, the discussion in the paper on the financial sanctions side, I felt, Oleg's presentation of it, I agreed with much more than the presentation in the paper, because I have this quote from the paper, which is that financial sanctions operate by limiting the ability of countries to borrow to finance trade deficits, reducing the ability for risk sharing and intertemporal consumption smoothing. That is certainly not the way sanctions practitioners understood the function of financial sanctions. Financial sanctions were fundamentally about denying an individual, a company, or even a central bank access to the dollar. You're freezing assets. You are requiring that every American financial institution reject a transaction if it comes through from that sanctioned entity. And there's a very smoothly functioning system where these banks, they upload a data set from OFAC, with a certain frequency, and if the entity that is registered in this transaction is on that list, it gets rejected. And so this is what we thought of as a financial death sentence. You are cut out of the dollar system, and as we all know, so much of international trade does take place in dollars. So it actually makes, adds huge transaction costs to operating in the world economy. And so it's certainly not just a question of denying the ability to finance trade deficits. Now, there was this intermediate set of sanctions that we imposed in 2014 where we initially said that Russian banks could not borrow longer than 120 days. And then we reduced it to 60 days. But that wasn't about denying them the ability to finance trade deficits. It was a signal that we were heading towards 0 days. So it was basically, if you want to threaten that the destination is full sanctions and full denial of access to the dollar, that was what it was. It was pointing to a direction of travel rather than that being the sanction in itself. So how effective have sanctions been? I think that Elena's description of the two episodes is very accurate. So first of all, there was a difference between the approach taken in 2014, 2015 and the approach taken in this more recent episode. In 2014, 2015, it was explicitly about changing behavior. We wanted Putin to understand that if he went further, there would be more sanctions. And at some point, he stopped going further. So that would suggest that at some point, he decided that the prospect of more sanctions was sufficiently unpleasant that he stopped. And so you can say that that's actually a success. Obviously, with hindsight, he only stopped for 7 years, but we bought 7 years. So you can chalk that up as a success, even though, you look at the economic data, they had 1 year of minus 2% GDP. They did have a ruble crisis, but that was probably more because the oil price fell. So, if you look at the economic data, you're kind of missing the point, because really what this is about is achieving a foreign policy goal. Then on 2022, obviously the sanctions were much more severe because the point was different. There was no concept at that point. Like, he'd already gone all out. He'd already invaded Ukraine. Forget about trying to change his incentives. Forget about trying to influence his cost-benefit calculation. This was just about trying to hobble Russia's ability to fight the war. And, there's no question that there has been a big impact on Russia of not being able to buy things from the West, for a period of time of selling oil for a slightly higher discount. But again, the key metric is none of those things. The key metric is, has he stopped? Like, have we actually succeeded in impairing Russia's or preventing Russia from fighting this war? And the answer is no, we haven't. He's still fighting. And so, ultimately, that's not to say, that's certainly not to say, therefore, sanctions don't work. Embrace the counterfactual that we did no sanctions. It just means that they have not achieved the objective, ultimately, that was hoped. So what explains the limits? So first of all, and this is, I think, very well presented in the paper, is that Russia is just a hard target. It's not small. It produces commodities that the world wants, needs, and will find ways of buying. It has a large domestic industry, so an industrial capacity for producing weapons. So, it doesn't have to buy those on the world market. It has land borders with China, with Kyrgyzstan, with Georgia, these black nights that are described in the paper. It had a lot of years to prepare for between 2014 and 2015 and 2022. It represses its political opposition, and and has done various other institutional changes to safeguard it from the financial sanctions that it knew were coming. Second is that, unlike financial sanctions, which, as I was describing, have this decentralized private enforcement mechanism through the banking system, these novel approaches to sanctions that were employed after 2022 do not have that built-in mechanism. So that's something that will have to develop over time, and cannot just be done by governments. And finally, the final key point, I think, which is in part a response to Robin put a lot of the blame on lobbying in the EU. I think actually the blame lies elsewhere, and I will be careful about that. The key issue was unwillingness to tolerate a potential spike in gasoline prices and the political sensitivity of that. It needs to be said that Europe endured a very sharp spike in gas prices, which had a major impact on its economy in the first year of the war. But there was no willingness to take something similar on the oil side. And ultimately, until that changes, and I believe that there are conditions now, a willingness to reduce Russia's ability to export its oil, not necessarily a lower price cap or a better enforcement of the price cap, but just a willingness to endure fewer Russian barrels going to the world market. If that doesn't exist, then ultimately Russia is going to have a lot of money and is going to be able to pursue its war aims.
Okay, let's open it up. Let me start with Ben Harris.
Thank you. So I really like this paper because it kicks off, or maybe it just extends, an important conversation around the optimal aims of sanctions. Sanctions are often constructed in really stressful, chaotic environments. It's not like we get to sit around in a room like this and spend half a day thinking about it. And so having a North Star and a framework for sanctions is really important. So this paper contributes to that. So I have 7 lessons I sort of learned from being on the inside that I'm going to share. These are largely an extension of Robin's comments, not surprising, but I'll try to be quick here. Okay, so the first is that sanctions are a repeated game in a dynamic environment. It's not as though Russia went ahead, invaded Ukraine, we came up with our sanctions, and then it was all done. The repeated game part is really important. So it's not just about trying to invoke deterrence in the current period, but also future periods as well. That means keeping your powder dry and reserving the ability to ratchet up sanctions in the future. It also means thinking through incentives around countermeasures. So you can think about, for example, in the context of financial sanctions, and potentially, you don't want to come in too strong because then Russia would then go ahead and invest in a complementary system, potentially along with China. So this is a repeated game in a dynamic environment. It's really complex. It's not just a one-off event. Second, sanctions are also a signal. And so it's not just about the change in behavior. It's also about a vote against the particular action of that country. Silence can be deafening. And so even if sanctions weren't effective at all, not doing anything in the wake of the invasion of Ukraine would have been problematic. Also, harmful to Russia was the exit of Western companies from their economy. That was not a public sector decision. In the context of oil companies, there was an enormous exit. Russia's ability to produce down the line will be diminished because you saw many of these private sector companies leave. Would these private sector companies have left if there was no signal sent? I don't know. My guess is probably not at the same rate. So there is a relationship between the signal sent by the public sector and voluntary exit by the private sector. The third lesson is maybe the most important, which is that frictions really matter. And so if you're just looking at export volume, you're going to miss a lot of the impact of the sanctions. Around the price cap, there was 2 things that matter when it comes to sanctions. The first was that the traditional shipping routes changed overnight. So instead of 3-day trips to Europe with crude exports coming out of Russian ports, we're now talking about 35-day trips to ports in Mumbai. That meant that Russia's spending a lot more when it comes to shipping. That's a really important friction. So you have to look at profits, not export volumes. Another important friction was the purchase of ships. Now, I agree with Robin pretty strongly that we should have disallowed the sales of Greek ships to Russia to build the shadow fleet. Same time, billions of dollars were spent building up that shadow fleet. That meant less money to buy military weapons and other problematic goods. That's lesson 3. Lesson 4, coalition dynamics also really matter. In order to get the price cap through, we had to get every country in the EU to agree to it. That meant getting Greece to agree to it, which you've got an economy which is entirely based on shipping. At the same time, going to the Balts, who are worried about having Russian tanks roll through their streets. It is an almost impossible compromise. I can't believe we got it done. The coalition dynamics are almost impossible, but they're a big part of this, and you have to take that into account when you're setting optimal sanctions policy. Okay, number 5. And I'm sitting in the same seat where Ben Bernanke said this in the context of monetary policy yesterday. The counterfactual really matters. Robin brought this up. There is a counterfactual where we're not having this discussion because the war in Ukraine is over because Russia completely conquered Ukraine, right? So we don't really know whether or not they were successful because we can't observe the counterfactual. Economics is often about the counterfactual. It's no different when we're talking about sanctions policy. Okay, lesson 6. There's not much of a discussion about the impact of the standard of living in the country being sanctioned. So it's my understanding if you want to buy a car in Russia right now and you want an airbag, you can't purchase that car. If you want to take a domestic flight, it's much harder to take a domestic flight. Some of that is captured in GDP statistics. A lot of it is not. I like having cars that have airbags. That adds to my standard of living. Some of that is lost in these official statistics and evaluations. Lastly, it's not just about the elasticity of substitution. And as Oleg and Alina point out in their paper, I mean, it's definitely partly about the elasticity of substitution, but it's also about the elasticity of demand. And so when we're evaluating the impact of a possible embargo, the European embargo on Russian shipping, our concern was not just political, as Rory brought up, but it was also macroeconomic. And so there were independent analyses, I can't go into our analyses, but there were independent analyses that show the price of oil would go up to $180 per barrel. And there was even one that came out of a major US bank that showed the price of oil would go up to $320 per barrel. That's a macroeconomic concern. That's a global recession overnight. And that's all about the elasticity of demand with respect to oil. So it's not just elasticity of substitution, it's also elasticity of demand. But overall, I really think this is an incredibly important conversation, and I want to thank the authors and discussants.
Jason?
I'm going to make these points and then have to leave. I'm going to give my own talk. Number one, just in 2014, when I was there playing a bit role while Rory was designing the sanctions, the amount of lobbying and the intensity of it from companies, American companies that thought they'd be losing out, including big companies, was just amazing, given how tiny this was for them. We did things like construct a stock index of companies that exported a lot to Russia and similar ones that didn't, like Coke was in one, Pepsi was in the other. We didn't see a lot of move around sanction stuff, but boy, whatever small thing there was mattered a lot to those people. Second is, in this experience, I was struck about how just incredibly hard to predict the consequence of these sanctions would be. After they were imposed, I didn't know Oleg and Alina, so I did the best I could, and I called Rory, who told me they weren't going to matter much. I called Sergei Guriev, who told me there was going to be no Russian economy within 2 months of the sanctions going into effect. And unfortunately, I think Rory was closer to right than Sergei was on that, but Sergei's like an enormously knowledgeable, smart person about the Russian economy. So I do wonder, when you're talking about metrics and impact and all of that, if you don't have like a great model that maps these things into outcomes, how can you even really try to do any of that? The third, which is not really for your paper, but is an incredibly important discussion in the United States and maybe a future paper, is just what the long-run consequences of this are. How much other countries build alternative payment systems, alternative sources of reserves, alternative trade patterns, and the like. And I get the sense there's an awful lot of people I know who think in general the United States has overused sanctions, and in every particular case they've underused sanctions, and trying to reconcile those two and figuring this out over the longer term is something vexing to me. So I look forward to hearing the answers later. Thank you.
Kostas?
Some of the imposed sanction measures. Just a disclaimer, not because I'm Greek. I don't own any, no shipping companies, I don't own or shares. But like as an international trade economist, so this is for a few reasons that, Oleg and Elena nicely displayed in their paper. So, I mean, first, because it's not just whether they work to make a dent in the Russian economy, but what is the impact on US and Western countries. It was big, of course. And, part of their work, of course, can explain that. But also there are two types of sanctions that I'm mostly skeptical, that I want to hear the views of the authors about them. And these both relate to economies of scale and capacity, something that the authors discuss less, and I want to hear their views. There was something in the second discussion about it. So the first is the FDI-imposed sanctions and the self-sanctions. So what happened here is that a bunch of firms left Russia, and they left incredibly high-quality capital that Russian companies were able to get for almost for free, basically. So that's kind of a transfer of wealth and capital. And then the second is sanctions on high-tech goods, which are indeed low elasticity substitution goods, but also they are economies of scale and high-capacity goods. So I feel like this may have given the opportunities to Russian firms to create the scale and capacity they needed to kind of further their, the technology and their capital. So I just want to hear if the authors thought about that and what they think.
Let me go online. Joe Gagnon.
Thank you. I'd just like to ask all the participants a question that I get asked all the time which is what is the role of the dollar in enforcing sanctions? A lot of people in Washington seem to think that the fact that the dollar is international reserve currency is the only reason we can impose sanctions. And my answer has always been, no, it's all about the relative size of the sanctioning coalition versus the sanctionees. And that seems to be what the first three speakers said today, so I take some comfort from that. And I'd like to get their insight. But Rory then, in his comments, said, well, actually, the dollar's role is important, and it's tremendously costly for the sanctionees to evade the dollar system. I guess I'd like to push a bit further and find out, Rory, do you have information on these costs and how big they are? I actually haven't looked into this, and I really would like to learn more. My sense has been that, yeah, the dollar may be a cheaper vehicle currency for most international transactions. Maybe just say, take for rough numbers, it costs 1% to process a transaction in dollars. And if you don't use dollars, you go through some other currencies, especially if you don't include the euro, it might take 2 or 3% of the cost of the transaction. So that'd be 200 or 300% higher cost. Sure, that's a big increase proportionally, but in terms of the value of the transaction, it would be tiny. I'm just plucking these numbers from thin air, and I wonder if you actually have a better sense of what these numbers are. How is it really materially more expensive for these countries to avoid the dollar? My sense is they'll happily pay 2 or 3% tax if they need to avoid using the dollar.
Rick?
So Rory, I think, was exactly right when he said that the metric should not be how much harm you do to the target's economy, but actually doesn't change their behavior. So I want to play devil's advocate here a little bit, which is that there could be a negative to sanctions in the following sense, that they give the country that's doing the sanctions an excuse not to do the really tough thing, which is to actually either provide direct military support or provide the arms. And this really does worry me, because I think that frequently it's a cheap way of sort of saying we're doing something when you're not doing what's really important. And that actually may give incentives for the target country to actually engage in bad behavior. So it's something that it's not so much the economics, but actually sort of the political aspect of this kind of thing. And this has really been very critical in terms of the issue of the support for Ukraine.
Randy?
Thanks. Really great, important stuff, both the paper and the comments. I wanted to think about going forward, how should we think about proactively setting up potential for sanctioned regimes? So, for example, obviously there's a lot of tensions with China, with Iran. And so would it be possible to kind of use the lessons, the political economy lessons, as well as the particular substance lessons on both the trade side of things as well as on the financial side of things, to be able to proactively think about, okay, what should we be doing now about something that might happen in 10 years, both in terms of trade issues, because obviously trade issues are very important right now. There are a lot of things that are kind of narrowly focused on current issues, but could there be something that has that longer run focus? Also, an important point was made about thinking about not just thinking about substitutions. So it's not just is something big or important, are there substitutes available for it? And this is on both sides, both for countries that we might want to sanction, but also because of dependence on certain things from those countries that we might want to sanction, and thinking about doing investments in building alternatives. In some sense, it's just good supply chain management, both financial supply chain and physical supply chain that any company should be doing. But I think it seems there are a lot of lessons, I think, from this for us doing that going forward.
Joe.
Yes, thank you. So obviously this is not a comment on the specific paper, but on the next paper, and is motivated by what Ben said about it being a repeated game. And I guess I was just going to ask, is it? So I'm going to contradict myself at least twice as a expression of my confusion. So on the first hand, I was like, well, you want to be very careful about introducing these sanctions regimes because you run the risk of losing the exorbitant privilege, and of course it's the reason why it's called a privilege. And then I thought to myself, well, but China understands this already, so they must be like just working their butts off trying to get avoid being in a situation where sanctions could work, just like Russia did and stuff like that. And then I was reminded, well, but you've asked people like in Europe, who must also be very tired about this and recognize that they are under the threat too. And I asked them, it's like, what are they doing? And they just stare at me. It's like, nothing. No, there's no work or there's no consideration of these factors. And then I'm reminded of like other things like some of the behavior of some of our multinational corporations. And it seems to me their lack of forward-looking insight into the geopolitical risks that they run when they invest in certain countries. So I guess it's just a question of like, how do I like think through these issues, and do I like go to my game theory textbooks that are buried on my shelf to kind of like think through these things, or is it just something much more mindless and simple?
Jan?
Yeah, I wanted to add 2 comments to the author's excellent presentation. So on the substitution point, there's always the ex ante fear of what will happen and uncertainty. And, for those who were here a year ago and saw the Moll, Schulerich, and Zachman paper on the German gas experience, they looked explicitly ex post at the amount of substitution. And Oleg and Alina know this, they cited it, but was much higher than was initially expected. And so that's a data point to have between sort of talking your book ex ante versus when under pressure, how much substitutability might happen ex post. The other point is, I agree with many of the commenters that the authors have done a great service by providing a framework for thinking about sanctions. And one of the advantages and value of having a framework is that hopefully it's generalizable, and so you can think about other questions and other episodes through that lens. So it's somewhat similar to Randy's suggestion. I wonder whether the authors have something to say, given their framework, about other trade policies that are actually very similar to sanctions in some ways by restricting trade. So have they thought about what we might learn about tariffs and other trade restrictions through their framework? We have some highly talented people in the room to comment on that.
Ethan?
Two quick comments. One is that I would have liked to hear more about the distributional impact on Russia, because the assumption is that harming Russia harms the decision makers in Russia. Russia is not a non-democracy. So, and Jamila Nigmatiluna, sorry, I'm butchering her name, estimates that the 2014 sanctions harmed the average Russian, but did almost nothing to harm, maybe even helped the oligarchs. So, we need to see that it's the decision makers that are being harmed, not just that there are less flows of goods going both ways. The other point is, underlying the theory of sanctions is a peace theory, a trade theory of peace, that trade is the carrot whose removal deters or penalizes war. And I wonder how to think about decoupling, not with Russia, but in general, the kind of in the world economy on kind of the probability of war. We tend to think about, decoupling. We need to secure supply chains, et cetera. But if we believe that sanctions are what could prevent war, this also takes away the penalty, a lot of the penalty that should avoid a war with China, for example.
Neil?
So both the paper and sort of discussion danced around this, but is it the view of the panel of the authors and discussants that a full trade embargo imposed by the West at the start of the war would have either stopped the war or led to regime change in Russia?
Abby.
Another brief question. There's been a lot of discussion of applying the framework to new instances going forward, of taking the lessons from implementation, repairing those, and codifying that to use in other settings, potentially. And I guess my question is, if faced with a kind of multiplicity of malign actors that you referred to, Alina, does that complexity, even if we were to nail down the framework and nail down the implementation, does that complexity alone pose additional challenges, either in your framework or from what you've seen in practice?
Okay, let's go back to.
Thanks so much. This is a lot of great stuff, and I just will pick on one or two things very quickly. So I think Rory put my quote from the text, and I think that's exactly how most economists think about what financial sanctions are. You limit intertemporal trade, you limit maybe trade between some agents. We don't really think that if you have spot currency that you cannot use it, right? So typically it's just not part of our models. And I think that's why it's very useful, this discussion between sort of academics and policymakers, is in the real world what we've learned is that actually not having the ability of exchanging a spot rupee or spot dirham for a traded good, purely spot market, you have the money, you want the good, and you cannot really do it. It turned out to be one of the biggest impediments. And historically, this is the last round of sanctions, which came with no sanctions, which came just with enforcement through the financial system last December, which actually proved to be much more impactful than many other import restrictions on Russia. And it's just not part of our models at all, right? And so this is, we kind of have to bring it in. What's interesting about it, it was much easier to substitute and find a real sector firm, like an intermediary to ship your oil, or a ship in Greece or something, than to find intermediary in the financial market. The question here is external validity, or can you extrapolate? It was the case this year. Will it be still the case, at the next episode 7 or 8 years later? Because obviously the countries adjust to it. So they knew now that was the bottleneck, and maybe it's no longer the bottleneck 8 years from now. And of course, you mentioned the sanctions bought 7 years. Russia used those 7 years, but European Union and US arguably didn't use those 7 years, right? And that was the biggest symmetry. I just want to respond back to what's the optimal policy mix. So I guess you really have to think, do you want to keep those things off equilibrium? Then you go at it with all you got, and it's costly. Or you acknowledge that it happens in equilibrium once in a while, and then it's a cost-benefit analysis, right? And so we give a recipe. If you want to go with all you got, you really have to limit the export, revenues, and you need to do targeted import sanctions, not the other way around, which was really done in practice. But that could be very costly. And that could be an acknowledgement. It's just too costly to do it. And then, well, maybe the alternative is, currently Russian military budget is 10% of GDP, and U.S. military budget is 2.7. So maybe then, going back to what Rick is saying, maybe it's not, oil embargo, which countries say is too costly, but then you have to do something else about it.
Thank you very much. So I think I want to think about the sanctions as sort of like transmission mechanism of sanctions, right? And we have different sort of ways, different parts, blocks of it to look at it, right? So if we have the policy rate and we do not know how it gets to the interbank market rate, we shouldn't be asking about the, the final target of the consumer credit, right? So I would love to know how it affects foreign policy, but we're still at the stage, how does it transmit to the interbank market? And I think that's where we wanted to have this conversation. So sanctions are using economic leverage or economic statecraft, using economic leverage for foreign policy, military, or other kinds of objectives. And I increasingly go to the seminars where people clearly come from the military. But we don't have a common language to talk and to discuss things. And when they ask me, oh, what is at least in your field, what is in economics, what is the impact? I even there don't even have a model to tell them. So I think that's the beginning. We're trying to say, well, how does it transmit? But yes, I agree, we need to take it further. I think there are a group of questions on the finance versus trade limitations and the the surprising effects of the payments versus trade. I think here we need to think about, for example, if you have the optimal tax policy design, but then you come to a country and realize they don't have the administration. So you have to compromise on some of your absolutely optimal mix of the income versus consumption taxation. You have to think, what can they possibly do? And we're in the situation where we have a hammer, it's financial sector sanctions, we can do them. We don't have the institutional infrastructure to do export controls or oil price cap, these new measures effectively. Why do we have the hammer? Partially because it's a critical node. We're controlling the critical node. We're not controlling a lot of critical nodes in trade. But at the same time, I think it's also institutional administrative capacity. So we spend, some people here have spent 30 years of making sure that banks understand that I can disconnect people from the dollar. We started after the Patriot Act in 2000s and blah, blah, and then we did whale hunting. You know, BNP Paribas, they got multi-billion-dollar fines. And now the financial system, when they say sanctions, they say how high. There are also, I think, very important differences. Can we translate that to the industry and trade? Well, financial industry is subject to runs. Right, you have the example. By the way, the 311 was taken off from Latvian Bank that day. I'm not sure why, but you have an example where the Treasury FinCEN announced that we have suspicion of money laundering. The bank is done, because there is an immediate run. If we have suspicion of intel sending through Kyrgyzstan or somewhere else to Russia, nothing really happens because we're not going to stop buying intel. There isn't a run yet from the banking system. So again, the banking system is also very regulated. Our industry is not yet. So we have all these institutional issues, which I think maybe mess up our optimal policy design, financial sector sanctions versus trade. I also want to pick up on the cost. I think the frictions, and we try to work it more into the thank you from the comments also earlier. It is very important. Russia spent estimated between 8 billion to 11 billion on the shadow fleet, and that is a cost potentially that didn't go to the war. And then in terms of the cost, I think there are some papers emerging, and Killian, I think, is one of them, which we quote, trying to mix theory and practice in terms of worked better embargo versus the oil price cap. Because Russian oil network, this discovery and delivery, historically aimed at Europe. There is a pipeline, most of the fields are in the European part. There is a friendship pipeline, which was built in the 60s. So there is this friendship. And then suddenly that gets cut off and Russia has to travel around, as you point out. That is also because of the European embargo, right? They have to travel around. And then you try to estimate how much of that discount is because of the higher leverage of India and China, and sort of reflected in the transaction costs. So I think that is definitely a very valid area to work on. I think that's, oh yes, and thank you very much, Robin, for bringing the Turkey example, because I think it's a beautiful example of the flip side. When we talk about what is the sort of the most sort of sensitive country on the financial sector sanctions, I think this is an example. And as you point out, it is true, you know, US didn't even do much. US just needed to call them, subpoena these banks to potentially show up. That was enough to send a very strong signal. So I think we'll definitely incorporate that.
Thank you. So that was our last session, but before we adjourn, let me just say a few things. First of all, I wanted to thank all the people at Brookings that make it possible for us to have this conference, in particular Hawen and Megan, so maybe a round of applause for them. We have a date for the spring conference. It's going to be March 27th and 28th next year. And then finally, last but not least, there's going to be lunch served, so please stick around and have lunch before you take off. Thank you.